market is seeing that the economy is not weak.
I would argue we've had a broadening out.
I think markets are still really euphoric.
You need some conviction. You need that to really anchor you, because we're going to have a lot of volatility.
I think we're actually going to get off to a bit of a sloppy January.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
Good morning to our audiences worldwide. This is Bloomberg Surveillance. John Farrell, Lisa Abramowitz, and Anne-Marie Hordern have the day off. I'm Romaine Bostick here at Bloomberg World Headquarters in New York. My co-pilot for the day, more than 5,000 kilometers away, Kriti Gupta in London, England. Happy to see you here on this Monday morning here in New York City, Kriti.
It's good to see you. I stayed late just to anchor with you, Romaine, just for you.
All right, well, we do have a lot to talk about. Let's get a lay of the land here. Financial markets worldwide right now on the back foot. We're seeing a slight dip today in stocks in Asia, in Europe, and S&P futures right now pointing to a lower open here in the U.S. You are seeing a bit of a bid into treasuries. That's pushing yields lower. The dollar relatively unchanged here on the day. Energy, commodities, also a little change. A bit of trepidation here on the penultimate day of the year. Coming up, Max Kettner of HSBC. He's going to be talking to us on why he sees a host of positive catalysts heading into 2025. We're also going to hear from Terry Haines a little bit later over at Pangea Policy on the life and legacy of President Jimmy Carter. And a discussion here about the outlook for investing in emerging markets, specifically in Africa. Runa alum over at Developmental Partners, Kriti, going to be joining us in just a bit. Not a huge amount of stories crossing the wires this morning, but obviously some focus today on what's going on in Washington, as well as what's going on in Korea with that airplane crash. Boeing shares right now here in the U.S. moving lower. But we begin this hour with a broader look at futures here in the U.S., which are pointing to a lower open. Investors trimming a little bit of risk before we get to the year end, but no matter which way you cut it, this has been a phenomenal year, a year that was largely driven by momentum. Stocks as strategy that so far right now is sitting on a record gain of 31%, but those gains have slowed significantly over the past few weeks, and a lot of questions as to whether the momentum of 2024 will be the momentum of 2025. Max Kettner over at HSBC joining the big program right now. And Max, we start off here with that big question, the parlor game right now, as to how much momentum is there into 2025.
Yeah, good morning, Romaine. Thanks for having me. Look, I think there is still quite a bit of momentum left, because at the end of the day, the economy is still doing pretty okay. And we start 2025 actually with a pretty similar setup compared to the last 2 years. Remember, in the last 2 years, particularly in the last last 4 quarters, we've always had around about sort of 1.5% GDP growth expectations for the US. That isn't really changing in the first half of next year. We're still looking at sort of 1.7, 1.8. So consensus is still convinced that those growth rates that we've been having for 2 years in a row, literally for 8 quarters in a row, those almost double the potential growth rates that we've had, that they are only temporary, and then we're actually going to go lower than we've been in the last couple of quarters. And on the earnings side, it's a similar thing. When we look at Q4 earnings expectations just in the upcoming reporting season that starts in a little more than in 3 weeks, we again see earnings expectations pretty much flat quarter over quarter. And actually, if we exclude tech from that consensus is saying earnings are going to drop quarter on quarter. So with such low expectations, with such an easy bar to beat, I think there's quite a lot of momentum still to be had, particularly in the first half of next year.
Will that be broad-based momentum, Max, or is this going to be a repeat of what we saw at the start of this year, where it was pretty much just a small cohort of large cap stocks leading that charge?
Yeah, I don't think so. I think it is going to be a bit broader, but I don't think it is a question of, are we going to buy the Mag 7? Are we going to buy tech or the other stuff? I think it's more a question of, we're going to buy the Mag 7 still and some of the other bits. So I do think some of the industrial, but also some healthcare, for example, US banks look really, really good value at this point in time. Even some of the defenses, when we look at utilities, how well they've actually held up in light of this increase in yields, with that AI story in the back. I think that actually there's a lot of sectors that really can support a bit of broadening out, but I don't think it's a story of, okay, ditch the Mag 7, ditch tech completely, and the rest is going to take over. I think it's a story of the Mag 7 and tech and some of the other stuff.
Well, Max, how much of the dollar strength that we're expecting in 2025 gets in the way of the strength, not only in the Mag 7, but in the broader index? Is the currency the Achilles heel of the S&P 500?
I don't think it's the currency. And in fact, when we look at some of our indicators right now, when we look at momentum signals, typical sort of CTA and momentum player signals, how long or how short they are, the dollar, we are getting to a very, very stretched territory of how long those momentum players are on the dollar. So I'm not sure whether that is going to be really a one straight line upwards. And we kind of know, we all know about this growth divergence between the US in the next couple of months, perhaps a little bit of relief. And on top of that, I think the Achilles heel, what you've been saying, I don't think it's the currency. I think it's much more on the yield and on the rate side of things. So we've been saying, look, while we are constructive for the first half of next year, and while, of course, a lot of focus is on the politics and what's going to come first in terms of the implementation or what comes first at all, right? Is it going to be tariffs? Is it going to be tax cuts and so on and so on? I think the much, much bigger risk, and in fact, the biggest risk to our constructive view, is if yields push higher, particularly the long end, and particularly like we've seen in the last month, if that is driven by the term premium. If we don't see real yields pushing higher, high inflation, both would actually be positive for equities, would be positive for credit spreads. But if it's just term premium, just an add-on in terms of costs, that really would be the biggest risk by far and the biggest Achilles heel for our risk on view for the first 6 months.
So, Max, you talk about that rate story, but what is the line in the sand? I'm looking at 460 on the 10-year this morning. Is it 5%? Is it above that? What's the line in the sand that spooks equities?
Yeah, actually, we've been looking at it for the last 2-3 months, and we looked at what we called the danger zone, which might sound a bit cryptic, but in fact, what we looked at is where is the level of yields, the level of long-run rates expectations, where equities and credit spreads and high beta effects, where they really start to suffer. And in fact, we've been pushing through that. It is close to 4.5%. So we are, in fact, at the moment, pushing a little bit through that. So the problem, I think, for the start of January is going to be if we're all going to start in January and realize, oh, this is not going to look good. And in fact, perhaps issuance needs to be put more on the longer end, and the next quarterly refunding announcement is going to show a little bit more issuance on the long end. If all those stories come true and we push towards 5%, so in fact, if we stay sustainably above 4.5%, that really puts a dent on risk assets. So far, it's not been the case.
All right, Max, a big picture question here, and this involves the interplay between the two largest economies. I think we have a pretty clear picture of maybe what U.S. economic policy, and for that matter, U.S. economic growth will look like. How much of a factor will China be in the global economic story? Are you anticipating at all a rebound, not only in the economy, but in the financial markets over there as well?
I think there is a rebound in store, particularly the consumption side of things. So I do think when we look at the last 2-3 months, there's been certainly a little bit more of a consumption boost, and particularly a boost in terms of the available or savings for the consumer, really. And that should be allowing really consumption, in particular in China, to be a little bit better. It's not something I think that will help Europe. So I don't think the typical trades or the typical proxy trades that people would put on, things like long European autos or long European luxury, I don't think these kind of trades will work. I think it's much more a story around China and Chinese equities in particular.
All right, we have to leave it there. Max, always great a conversation. Max Kettner, Chief Multi-Asset Strategist over at HSBC, kicking us off here on Bloomberg Surveillance on this Monday morning in the U.S. S&P futures pointing to a third straight day of declines. Let's get you an update, though, on some of the stories outside the world of finance. Our Bloomberg brief and Kriti Gupta.
Remain infighting in Congress this month and Republican pushback on GOP House Speaker Mike Johnson. Some party hardliners haven't committed to re-electing Johnson as Speaker after he backed a temporary spending deal that didn't include President-elect Trump's initial demand for lifting the U.S. debt ceiling. But others in the party are pushing back on calls to remove Johnson. President-elect Trump hasn't taken a public stand on Speaker Johnson's future. The House speakership vote is scheduled for January 3rd. Now, Bloomberg is reporting on how Trump's foray into politics has changed the way some countries are looking at his Starlink internet business. South Africa's president and Musk have been in contact to discuss ways for the government to change the rules to allow Starlink's high-speed internet to operate legally there. Those talks, according to their sources, included discussing investment by Tesla in battery production in South Africa. Musk's new role makes it harder for some governments to resist Starlink, which this year added 20 new operating countries and now serves more than 4 million people in 100-plus countries. And it was a race for number one at the Christmas box office, with Disney's Mufasa narrowly beating out Paramount's Sonic 3. The Lion King prequel claimed number one over the 5-day holiday stretch with $63.9 million, while Sonic 2 pulled in $59.8 million. Rounding out the top three was the anticipated horror remake Nosferatu with $21.1 million. Romaine, that's your Bloomberg Brief.
Yeah, and coming back here, we are going to take a look at the life and legacy of President Jimmy Carter. The condolences still pouring in. Xi Jinping just moments ago sending his condolences to current President Joe Biden about the passing of our 39th president. The life and legacy of Jimmy Carter coming up after the break. This is Bloomberg Surveillance. Under surveillance this morning, the life and legacy of former U.S. President Jimmy Carter.
President Carter came to office in the wake of Watergate and Vietnam with a commitment to right the ship of state.
President Carter brought back to government honesty, integrity, and faith in government. He ran as a candidate on a government as good as its people, and he truly did deliver that.
I think President Carter, in many ways, was ahead of his time in terms of his emphasis, for example, on human rights, in terms of his thinking about alternative energy, in terms of his role in the Middle East peace agreements that he put together. And we all know that his ex-presidency, which has been such a long one, has been graced by remarkable contributions to humanity by former President Carter. I think right now, he is seen very favorably. I'm really happy to see that because he's a very special man.
One of President Carter's biggest challenges was energy in the face of the second Arab oil embargo.
Well, he was president during a very challenging time. As you recall, there was the oil embargo, which drove oil prices up dramatically. That became a catalyst for the highest inflation that we had really since the war, and probably even before that. And so he had to take some very tough fiscal measures. He did appoint Paul Volcker, who, by very much tightening monetary policy, caused a recession, which certainly was not an easy thing for President Carter to run through.
He was the first person to talk about energy and how we had to start looking at renewable energy plans and how our country could invest and incentivize in that area. And I don't know if you remember, but he had a solar panel on the White House, which when he left, President Reagan took down. But he had fuel mileage standards and, really realized, I think, way before anybody else that we had to start thinking about what climate and what it was doing to our planet.
But as influential as Jimmy Carter was as president, he will be remembered every bit as much for what he did after he left office.
The thing, though, that I think is absolutely most notable about President Carter is we can all debate the relative merits of any individual president's term, but I think it's inarguable that President Carter is the single most impressive, most successful, and most to be admired ex-president in the history of our nation. This is a man who took the responsibilities of being a visible public figure incredibly seriously and was a role model to all of us.
And current President Joe Biden designating January 9th as a national day of mourning for former President Jimmy Carter. Carter died at his home in Georgia yesterday at the age of 100. Terry Haines of Pangea Policy joins us right now to help reflect on the life and legacy of Jimmy Carter. A lot of important dates there. We talk about January 9th being a day of reflection and remembrance. Of course, his birthday, October 1st, back in 1924. His death, of course, on December 29th. But I want to start, Terry, with July 15th, 1979. That was the day that Carter gave that famous malaise speech. And just a few weeks after that, appointed Paul Volcker as chairman of the Fed to fight what at the time was just an almost unprecedented level of inflation that this nation was facing, a level of inflation that for years he didn't necessarily get credit for taming.
Oh, I think that's absolutely true, Romaine. Good morning to you and Critty. I think it's absolutely true. I said to markets this morning, I think they should all thank and remember Carter for the crucial role that he played in breaking the back of inflation over several years. I mean, that was as well as not only appointing Paul Volcker, but defending Volcker personally and Fed independence through his term, something which President Reagan also did at no small political cost to Reagan, even though he eventually got the benefits out of it. That set the stage for not only the great markets runs that we've seen, even through great geopolitical crises, health crises like COVID, a bunch of other things, but also set the stage in helping the United States win the Cold War by boosting the relative economic strength of the United States against the Soviet Union at a crucial time.
It's kind of interesting to read some of the biographies of Carter, particularly some of the ones that have come out over the last decade or so that have really painted him, I think, in a much better light than maybe how the country viewed him back in 1980 when he lost to Ronald Reagan. And I am curious that if it weren't for the hostage crisis in Iran, the oil embargo, and of course, the level of inflation, is it possible that he might have been reelected in 1980?
Oh, sure, absolutely. The President Reagan's run, the then candidate Reagan's run began fairly late, and Carter was absolutely bedeviled by a lot of these policies. I've met President Carter, but I was privileged to know a lot of the people that were his senior aides, most prominently, including Jody Powell, who I knew decently well, and so got a window into a lot of these things. And Carter's strengths turned out also to be some of his weaknesses. The mulishness and commitment that he showed to Volcker, which made such a huge difference for the country, even today, was also in large part what helped bring him down. He had a split in his own party that led to a primary challenge from Ted Kennedy. He had a revitalized right under Reagan that ultimately swept him out of office. And he also was guilty of probably too much candor in talking to the American public about things like malaise that you bring up that led to the impression that he was either out of control or unable to respond effectively.
So, Terry, that's a lot of the domestic story. Let's talk about his record internationally, his foreign policy record, the Camp David Accords, his role in the Panama Canal, even boycotting the Moscow Olympics as well. These are all flashpoints that are just as relevant today as they were during his tenure as president. What does Donald Trump take away from that? Are there lessons to be learned?
Absolutely. And the first lesson to be learned, I think, is that the presidency has limits. Every victor in a presidential campaign, and the people around him tend to be a little triumphalist. They all want to talk about legacies mandates and the like. Clinton came in 92 talking about a mandate when he had basically won 43% of the vote. There's always a lot of salesmanship that are involved in it. But the lesson you can learn from Carter's presidency, and a lot of presidencies, frankly, is that the presidency has limits, and it's wise to remember those even while you're trying to maximize your political benefit in the moment. What Carter's presidency showed really was that he found it very difficult to bring his own congressional party along with him. Congress is a co-equal branch of government and acts like it, and he didn't. And Carter's also, while president, did not bring the public along with him as much as try to lead public opinion, and that also came back to bite him. So it's a balancing act with presidents, and any president after Carter was wise to remember that.
Terry, we talk a lot about energy security, and we certainly did, and in the context of the oil embargo during Carter's time as president, but we're also talking about it now in terms of tariffs, in terms of what's going on in the Middle East, and the idea that the United States is the largest energy exporter in the world at the moment. What does that mean for the here and now? When we're talking about modern politics, is that a good thing, or is that a bad thing for the United States?
On balance, I think it's a good thing. I mean, we have strengths and weaknesses geopolitically, but one of our geopolitical strengths is energy and energy export, and we are in a situation now where we're in the most difficult geopolitical risk situation in more than 50 years. So it behooves the United States, no matter who's president, frankly, to make sure that it uses its advantages wisely, but that it maximizes those advantages as well. Certainly, energy is one of those, and I'd frankly look to the next administration and President Trump personally to try to do everything possible to maximize that advantage.
Let's talk about President Trump, the 47th president, his inauguration on January 20th. What is his relationship going to be like with world leaders, particularly in contrast to kind of what we saw with Carter back in the 70s? I know they're two completely different people with two completely different agendas here, but are there any parallels that we can draw?
Oh, absolutely. And I think Carter had, Carter had a very fractious relationship with many countries in the world. His China policy was very successful, but on the other hand, even coming up with the Camp David Accords required that kind of hard-headedness, that mulishness that I lauded him for earlier on monetary and economic policy, and he succeeded in that. He did not shrink from confronting world leaders in a way that he tried to push the benefits of peace and United States hegemony. Frankly, this is a different world. But Trump has that same broadly kind of push-pull relationship and fractiousness. It's going to be the thing I would just say to President Trump is, a spoonful of sugar will really help a little bit. He's been largely succeeding in pushing allies towards greater defense spending and a variety of other things. He can continue that, but it's going to take a little more. It's going to take some finesse, and he's shown the ability to at least understand that, and that's a good thing.
Terry, appreciate you coming on. Obviously, we had a totally different conversation planned for you, but really great to get your insights on the life and legacy of Jimmy Carter. Terry Haines there of Pangea Policy. And Kriti, we talk a lot here about what Jimmy Carter did while he was in office. We would be remiss in not pointing out that some of his biggest accomplishments came after he left office. Of course, all of his work with Habitat for Humanity and some of his other charitable endeavors, absolutely remarkable.
Yeah, winning the Nobel Peace Prize in 2002 for some of his efforts of disease eradication in impoverished parts of the world, and certainly earning him quite a bit of not just condolences as the former president, but as truly a game changer for a lot of the kind of other ills that are plaguing the world. Yeah, absolutely here. And of course, Joe Biden saying that there will be a National Day of Remembrance on January 9th. There will be a state funeral as well as a private service that the family has planned down in Plains, Georgia, where Jimmy Carter was born about 100 years ago, earlier in October. All right, coming up here on the program, we are going to take a closer look here at what's going on in financial markets, and we're going to take a look back here at some of the key interviews that we've had over the year with some of the biggest players on Wall Street. We're going to hear from Citadel CEO Ken Griffin. He has sat down with Sonali Basak just a few weeks ago. You definitely want to hear what he had to say about the future of financial markets and, for that matter, the future of politics. S&P futures still pointing to a lower open here on this Monday afternoon in New York City. And to our audience worldwide, this is Bloomberg Surveillance.
Welcome back to Bloomberg Surveillance. Romaine Bostic alongside Kriti Gupta filling in today for John Farrow and company. A quick check of where we stand in U.S. futures, pointing to a lower open, potentially a third straight day of declines for the S&P 500 in what is still going to be a phenomenal year here on this penultimate trading day of the year. NASDAQ futures slightly lower as well. Russell futures getting a small bid, and a small bid also coming into treasuries as well, seeing a slight decline in yields, erasing a lot of the gains, the price gains that we had on a year-to-date basis for U.S. government bonds. Keep an eye on German bonds, though. We are seeing some movement there on the back of that Spanish inflation report. And then we take a look at the dollar. The dollar relatively unchanged here on the day. But again, you take a look at that chart and it really doesn't tell the whole story. The dollar versus a basket of its peers up 7%, and against the euro up about 5% on the day. Keep an eye on a few key stocks moving here on the day as well. Volume is light. Boeing, one of the biggest decliners in the pre-market session. VeriSign, one of your biggest gainers. Meanwhile, we refocus here on what's going on in politics with President-elect Donald Trump facing a bit of a rift among his Silicon Valley backers over immigration. Debates ramping up over the future of H-1B visas. Ken Griffin says U.S. immigration reform is one of his biggest concerns. The CEO of Citadel sat down with Sonali Basak at the Economic Club of New York just last month. Here's what he had to say.
Immigration is an area that the Trump administration is going to be very focused on. And it's an area of real concern to me because much of our nation's success is rooted in our ability to attract the best and brightest from around the world to work for American firms and to start American firms. Roughly half of all the firms in the Silicon Valley that have been launched in the last 20 years are led by immigrants. And I would say roughly the majority of Citadel's leadership team is immigrants. These are people that have come to this country, they've left everything behind because they believe in the American dream and the opportunity that our country represents. And yet, I think everyone agrees that the chaos on the southern border represents a broken immigration policy, where there's very little control over who comes into our country, whether they come here to pursue the American dream or for more nefarious reasons. I think there's widespread agreement across our country that we need to secure our southern border and that we need a far more orderly structure for immigration to America. So this has been a really important voice that the American voters have delivered to Washington. And I'm pleased to hear that voice, but I'd like to see Washington now execute on an immigration policy that is thoughtful, that protects this nation's great stature in the world of being the country you come to pursue your dreams. And on that note, for just a moment, I was in Europe last week and had a chance to talk to some of the most senior policy leaders in Europe. And do you know what they talk about? They talk about how Europe loses its best and brightest to America. They talk about how the Europeans have had a number of just absolute world-leading minds in AI, and how virtually all of them have left to come to America. We need to keep that position in the global war for talent. The second area that's very front and center on the minds of the American people is inflation, which I think ties into the economy holistically. And I think that for most voters, it's not clear what the right economic policy should be with a very fine, pointed pen. But they do appreciate that when your economy is at full growth potential, when unemployment is right around 4%, that is about as good as the economy should be, and yet inflation was running hot, and our deficit was running roughly 6 to 7%, which is a number that you would have last seen, obviously, during the COVID pandemic, and then prior to that in World War II. So at a moment in time where the U.S. fiscal house should have been looking pretty strong, or in other words, our deficit, in the Clinton days was actually a surplus when the economic environment was similar. when the deficit should have been closer to zero and was running closer to 6-7%, the American voter knows something's wrong in Washington. Now, the challenge is, and this is, like you asked what I worry about, will Team Trump, will this administration be able to find a path to put America's fiscal house back in order? So that's one of my real concerns, because we cannot continue to run this level of profligate spending. And that's a big issue.
So over the course of the next hour, we'll go into different policy measures, how you think they should be addressed. And also we'll shift gears and talk about the market implications as well and how you navigate around it. But let's start there. Let's start with the deficit, because prior to the election, you had the Committee for the Responsible Federal Budget saying that you would really have an administration with the proposed policies ahead that would add $7.5 trillion to the national debt over the next decade. How do you start to trim that fat? I mean, how do you start to bring that number down?
So here's the question. How much did both candidates run on a strategy of promise the world and then deliver reality post-election? I mean, neither party had a compelling story as to how they were going to put America's fiscal house in order. And I think it's very difficult to have judged either Vice President Harris or President Trump on the merits of their economic policy, because neither set forth a plan that was substantive, tangible, and would achieve the results that we need for the American people. And I think that's part of the reason that, for example, the Secretary of Treasury is so important, the role of the Senate, the role of the House. We're going to have to see the Republicans govern and make some very difficult decisions about where to cut, what tax cuts, if any, happen or are maintained. Like, we've got to put the fiscal house in order. And these are really unpopular decisions for politicians to make.
A big part of that $7.5 trillion projection really does come from tax cuts, more than you've seen in 2017. Do you think any of those can get done with where the deficit stands today? Of course, this administration is very different than when we saw Trump back then, given the size of the deficit ballooning.
So in both scenarios, Trump has inherited the following problem. American productivity is below where it needs to be for us to deliver on the promises that we have delivered to our retirees and our forthcoming retirees. Like, there's no way out of our current situation in terms of the promises that we've made other than to get American productivity up. I think in the first set of tax cuts, and to be clear, I think Trump made a bet. If we cut taxes, if we incentivize corporations and investors to take more risk, to put more money into R&D, to put more money into capital, to put more money into software and to modernize their businesses, we will get the productivity gains that we need.
And that was Ken Griffin, of course, the CEO of Citadel, the world's largest market maker, speaking a little bit earlier this year with Sonali Basak on a wide range of issues, though, of course, a big focus by Ken Griffin on politics. So let's get you an update on some of those stories outside the world of finance with our Bloomberg Brief. Kriti.
Romaine, Ukraine's gas transit deal with Russia is set to expire tomorrow, potentially bringing billions of cubic meters in gas flows to a halt. A dispute has escalated in recent days, with Ukraine's President Zelensky accusing Slovakia's prime minister of making shadow agreements with Russia's President Vladimir Putin. If the deal isn't reached, it will have major implications for Europe's energy security and the EU's efforts to reduce its reliance on Russian energy. South Korean political turmoil continues. The country's investigators sought a warrant for South Korea's President Yoon Suk-yeol. The impeached leader repeatedly defied court summons to appear for questioning over his decision to declare martial law. Yoon has vowed to keep defending himself, insisting the move was within his constitutional powers. And staying with South Korea, 179 people were killed when a Boeing 737 crash landed at the country's Muan International Airport on Sunday morning. Investigators are probing the cause of the country's worst ever civil aviation accident. The pilot issued a mayday minutes after the control tower warned of a bird strike. Investigators will focus on an unusual landing gear failure in the final moments of the flight. A second aircraft from the same airline suffered a similar fault this morning above Seoul before returning safely to the airport. Romaine, that's your Bloomberg Brief.
Thank you, Kriti. Coming up next here on the big program, investing in Africa.
Here in Africa, the African Union actually is adopting a set of policies that are Africa-wide. And I think that's a smart approach. That's the opportunity, I think, geopolitically for Africa right now, is to harness this technology and think about the route for entrepreneurs to get to scale.
That's coming up next. You're watching Bloomberg Surveillance. Under surveillance this morning, investing in Africa.
Here in Africa, the African Union actually is adopting a set of policies that are Africa-wide. And I think that's a smart approach, like how you get common rules at scale is going to make a difference. So the big opportunity for Africa, I think, is to have the 2 billion people here under a similar set of rules and guidance so that an entrepreneur in Nairobi can come up with something that can scale to 2 billion people. And that's the opportunity, I think, geopolitically for Africa right now, is to harness this technology and think about the route for entrepreneurs to get to scale.
And that scale is important. The world right now vying to invest in the fastest urbanizing place on Earth, and that is the continent of Africa. Runa over at Development Partners, writing about the continent's urban growth, saying this also drives consumption, and the consumer class is forecast to make up 60% of the population by 2060. Runa has been involved in private equity for more than 3 decades, most of that in emerging markets in Africa. Great to see you. Early Happy New Year to you, Runa. And I do want to talk about that investing opportunity. We've talked a lot over the last couple of years about those investment opportunities. And I think it's kind of interesting that most of those opportunities, at least right now, seem to be more in private markets rather than in public markets.
That's exactly right, Romaine, and thank you for having me on again. Happy holidays to you. You're absolutely right. And as I look to 2025, there are 4 major themes that we're looking at. The first is digitalization, which we've talked about before, and the clip from Matt Griffin pointed out. Africa has some of the lowest legacy assets in any area. Digitalization is driving it forward at a much faster pace than the rest of the world. So in the last 10 years, internet usage went up 6 times. 66% of mobile transactions in the world are now in Africa. So that's the first theme. Companies that benefit from digitalization, that can be fintech, can also be embedded finance, can be in pharmaceuticals, in agribusiness, specialty chemicals. And then the second theme we're looking at, which is somewhat new, is energy. So the energy transition has been talked about globally. Africa is now realizing how much hydrothermal it has in southern Africa, but wind and solar. So we're going to be looking at companies developing in Africa in that area, taking advantage of that. Another theme is...
Yeah, I'm just curious. I just want to stop you there for one second, particularly on the issue of urbanization and these urban populations. And I see the opportunity. I am curious if you can talk about some of the risks, because there have been some interesting reports about how some of these countries, which have seen a lot of gains, are kind of just one big exogenous shock or maybe an endogenous shock away from kind of having those gains wiped out. And I think about kind of the youth protests in Kenya that we recently saw, as well as some of the brain drain issues that we're seeing in Nigeria. How do you sort of, as an investor, sort of approach that type of risk, which does seem, at least on the surface, a bit more ephemeral, a bit more harder to wrap your arms around?
Yeah, Romaine, I think exogenous shocks are true everywhere in the world. I've been investing in Africa for 25 years. There's been many such events that you referred to. However, the underlying themes of great population growth, 40% of the world's population will be in Africa by 2050. Urbanization, as you pointed out, which leads to further consumption. And then the growth in GDP. This coming year, 2025, Africa will be equal in growth to Asia. By 2026, it will outpace Africa, which, by the way, is a couple of years earlier than previously projected by the IMF. Those things in combination create a situation where, despite the shocks, there is a supply-demand gap, and those are the sort of companies that we look at in private equity that we invest in.
Runa, the case is quite clear from a demographic point of view of why Africa is looking pretty juicy for returns. But there's been a dynamic this year in particular where so many French banks that have these historical partnerships and historical ties to Africa have pulled out, the likes of SocGen, Crédit Agricole, BNP Paribas, because they just can't make it profitable, and they're getting basically outperformed or they're underperforming some of the more local banks. What flips that dynamic?
That's exactly right. With the growth of local banks, the big banks in Nigeria, South Africa, but also Egypt, Morocco, and other countries, these banks are growing. They have really high returns on assets and return on equity. So it really is adopting the banking model to the local needs, and local banks have outperformed. And so for African consumers and African companies themselves, yes, the international banks, some of them, not all of them, are pulling out, and the local banks are taking their place. But that's an opportunity both in investing in those banks as well as an opportunity for local businesses, be they large corporates or SMEs, to actually have better banking services. For us, the big trend there is that both banks and fintech are looking to the underbanked in Africa. There's a great need and opportunity there, using digitalization to get to smaller enterprises, to get to consumers. And so I see opportunity in the trend that you just mentioned, because we invest primarily in local companies.
Well, Runa, you have the advantage of operating in the private market space as well, and you hinted clearly and alluded to that idea of low banking penetration. But in a world where private equity, especially in the EMEA region, is looking for a lot of support and a lot of kind of government backing and security there, how confident are you that Africa can compete with the same returns that you're seeing in Europe and parts of Asia, even in LATAM?
Well, it's really the growth. That's the story. The growth in our companies can be up to 100% a year. And the growth in the economies, there are 23 countries in Africa in 2025 that are projected to grow 5% or higher. And that growth feeds into returns. So absolutely, there are exogenous shocks. There is issues sometimes with volatility in countries. That being said, our companies are growing very fast. Our loss ratio in Africa is very low compared to other parts of the world in private equity. What that means is there are investable opportunities. So the macro that you're referring to is part of Africa. It's part of many parts of the world. But the opportunities within the companies themselves, if you pick the right companies, you put in what we in private equity call real hands-on value add, and you're able to exit properly. That's a big opportunity. By the way, another trend, which I'll refer to now, is the interaction between the Middle East, a $3 trillion market, in Africa. Africa and the Middle East are neighbors. And in the last couple of years, we've seen Middle Eastern entities buy our companies. We've seen our companies buy Middle Eastern companies or do joint ventures. Yeah. That integration, which helps returns and helps exits, is another big reason to be optimistic in Africa.
It's interesting, too, to see just how much Middle East investors and have sort of increased their presence. I am curious about the sphere of influence across the continent. There's been a lot of talk about China and Russia's influence, at least from a geopolitical standpoint. President Joe Biden made a trip over there just earlier this month, of course, promising billions of dollars in relatively humanitarian aid. But there was a lot of talk about infrastructure investment as well. And I am curious as to how all those pieces fit together, Runa.
It is interesting. This last year, Africa has received attention globally. So if you look at the following things, Africa now, the African Union has a permanent place in the G20. South Africa is the current president of the G20. The G7 have created a initiative called the Build Back Better World, where the EU and the US are set to invest in Africa. And of course, there's China's Belt and Road Initiative. A lot of attention. The EU and the US are also pledged to really support the Lobito corridor, which is the corridor from Angola to the Copper Belt. And so all of these things are playing into the fact that Africa is coming into its own as a geopolitical power on its own right. And that is getting attention, which we think a lot of investment follows once that attention is there.
One other interesting aspect I've seen with regards to investing in Africa, and this probably applies a little bit more to public markets than private, but it is this search for kind of the big beneficiaries of artificial intelligence, a trade that you know has been very concentrated in the U.S. and concentrated among just a couple of big companies like NVIDIA and Microsoft. There was an interesting note out by AQR, Cliff Asness's firm, just a little while ago, talking about how the next big investable opportunity in AI is going to be in emerging markets and specifically in sub-Saharan Africa.
You're absolutely right. And that is the same trend, the continuation of the digitalization trend. If you look at our companies, we've been focused on the first level of digitalization, which we started around 2020, around the COVID period, where all companies had to digitalize. This year and going forward, we're focusing on AI because that's the next logical trend. The more sophisticated companies get, again, very low legacy assets compared to the rest of the world, the more concentrated and better they get at reaching consumers in an intelligent way, the better they are, companies are in creating revenue and increasing EBITDA. So I expect AI to be part of the whole ecosystem in Africa over time, and starting with the larger companies. But also in Africa, we now have a venture capital area, and that is also highlighting AI, use of AI in some of the business models there. So yes, I do expect AI to have a bigger impact over time in Africa than most other regions of the world.
Well, Runa, one of the key pieces of that AI story, even in the United States or in the UK and in Europe, is this idea that you need a talent pool to keep that going. You need a talent pool who can not only create that technology, but sustain it. Does that talent pool exist in Africa, in sub-Saharan Africa, in South Africa, in other kind of hubs in the continent?
Yes, there are 4 major hubs where the undersea cables landed several years ago. First, which is Egypt, Nigeria, Kenya, and South Africa. That's where the talent pool, engineers, computer scientists exist. Without a doubt, there has to be more training throughout the continent and in those hubs also in AI. But we're seeing quite a lot of young people going into these areas. We also see diaspora coming back. We have a company called MoneyPoint, which is in fintech, and it's headed by a Nigerian who actually is diaspora also working on the continent, now having created a unicorn.
Yeah.
Very good example of talent, Africans looking at Africa and local talent being developed.
All right, Runa, I have to leave it there. Always wonderful conversation. We'll catch up with you in 2025. Runa alum there over at Development Partners International, conversation about investing in emerging markets and investing in Africa. As we take a quick check here, Kriti, right now, what's going on in the commodity space. Kind of an interesting year for oil. We talk about how crude oil, at least Brent crude, started the year with like a 15% rally. It's relatively unchanged on the day, but more importantly, down 4% on a year-to-date basis now, so erasing all of those gains. Though you see the flip side of that, coffee and gold down on the day, but both sitting on phenomenal gains, Kriti, on a year-to-date basis.
Yeah, it's a pretty fascinating one. 74 handle on Brent crude. How much of that changes if you're pricing in an inflation uptick, Romain?
Kriti Gupta over there in our London bureau. Romain Bostic here in our New York headquarters. A lot more coming up on Bloomberg Surveillance, including Cameron Dawson.
Market is seeing that the economy is not weak.
I would argue we've had a broadening out.
I think markets are still really euphoric.
You need some conviction. You need that to really anchor you because we're going to have a lot of volatility.
I think we're actually going to get off to a bit of a sloppy January.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
Good morning to our audiences worldwide. Romain Bostic here in Bloomberg's world headquarters in New York City. This is Bloomberg Surveillance. I guess they didn't want me alone. So I'm joined right now by the illustrious Sonali Basak. Great to see you. Happy holidays.
Great to see you. Happy holidays.
Of course, we are filling in for the trifecta, Anne-Marie Hordern, John Farrell, and Lisa Abramowitz. Not necessarily in that order. I don't know exactly how they dice that up or not. But let's get the lay of the land of what's going on in markets. It's going to be a light week here. I mean, this is a holiday short week. Wednesday, of course, the stock market is closed for the New Year's Day holiday. And it's just the second to last trading day of the year.
Light week, but down note. Of course, thin trading volumes. However, we are seeing actually December being the worst month we've seen since April. Already, of course, we had that big sell-off after the Fed meeting. But we'll see whether this is just a change in attitude or some profit taking at the end of the year.
Absolutely. Futures right now here in the U.S. pointing to a lower open on both the S&P and the NASDAQ. Russell futures relatively unchanged. We should point out stocks both in Europe and Asia are on the back foot as they have been for the last few days. Euro dollar relatively unchanged on the day. And keep an eye on what's going on in the world of treasuries. A slight downtick in yields, down about 3 basis points on your 10-year. We should point out, though, as Sonali was just pointing out, these numbers, this down month, this down day that we're having, not really reflective, though, of what has been a phenomenal year pretty much across most asset classes. Stocks right now sitting on 20 to 30% gains here in the U.S. And also you made a little bit of money in the fixed income space. And if you invested in gold, Bitcoin, well, congratulations, golf clap to you. I hope you take your profits and maybe look for something else to put it into, or maybe not. Let's get some insights out of our next guest as we kick off the 7 a.m. hour here in New York City with Cameron Dawson of NewEdge Wealth. He's going to talk to us here about maybe the lack of breadth in the market and whether that increases. We're also going to hear from Kim Wallace over at 22V Research on the political situation and a reflection on the life and legacy of President Jimmy Carter. And Parmi Olson, you definitely want to hear from her. She's a Bloomberg opinion columnist, but been covering the tech space for years, and she has a great book on AI called Supremacy. We're going to talk to her here about the future of the AI trade and whether it's going to eat all of our lunches. But we begin this hour with the stock rally on pause as we head into the end of the year, but equity still on track for a third straight year of gains. A Mag 7 leading the way. Just 10 stocks right now accounting for the S&P 500's gains since that October 2022 low in financial markets. You can see the graphic there. And, well, you point the camera now to our first guest, Cameron Dawson of our NewEdge Wealth, joining us right now to talk a little bit more of whether that lopsidedness that we saw at the start of 2024 is going to be lopsidedness at the start of 2025.
I think the most important point about breadth is that it actually has been supported by earnings. The reason why the market has been narrow, it's because earnings growth has been narrow. So it's not just valuation alone, and we've seen that in the last 4 months. If you look at the Mag 7, their earnings estimates have actually been revised higher by about 15%. But if you look at the equal weight index, their earnings have been revised lower by about 5%. So that spread in earnings revisions and earnings strength is really what has been driving the fact that this market is led by such a few short names. The question is, if you look at estimates in 2025, they have the everything else starting to really participate in earnings, but that's a pretty high bar and pretty much a show me story as we get into next year.
How much, if we do get a broadening of the earnings picture, how much of that is dependent on economic conditions and, for that matter, policy conditions coming out of Washington?
It is rather peculiar that we've seen this economic growth environment where we've had consistent upside surprises to growth. We've had growth be above trend, and yet it has not materialized to the everything else earnings, meaning that you've had this strong GDP environment, but the average stock has continued to struggle. Part of that is just an overhang from the pandemic. You had some over-earning that happened. Margins got overextended, and that was coming back in. But what you have now is this expectation that you'll have a huge reacceleration in those 493 names. We're not sure if you get that in a potentially decelerating nominal growth environment.
You know, it's a little earlier that Romaine had mentioned the bond market. You're seeing that bid come back into the bond market in the last week of the year. However, just last week, we were at 461. Again, on the 10-year. At what point does that start to get in the way of this equity market rally, or is it already getting in the way?
The thing that's been most surprising in 2024 is how much we've been able to see multiple expansion despite having rising bond yields. If you look, forward multiples for the S&P 500 are up about 17% over the course of the year, and that's with a bond market that has seen this constant pressure and rising yields. So at a certain point, is a 22.3 times forward multiple consistent with a bond yield at 4.6%? We always have to remember that valuations are very very poor timing tool, but we're getting to a point where equity risk premiums are incredibly narrow, incredibly tight. So as equity investors, you're not necessarily getting well compensated for the added risk.
But even if you believe that the reason yields are higher is because of strong economic data, then does that mean that any vulnerable economic data could set the market a little haywire?
I think that is a really good point, is that if you're looking at things like credit spreads being ultra tight, valuations being so high, it's not contemplating any kind of growth slowdown. So if you were in an environment where you're seeing growth estimates get cut versus getting raised, that would be a challenge to valuations. We think the most important charts over the last 2 years is GDP estimates for 23 and 24. It has been a constant climb upwards. And if that starts to go in the other direction, meaning we're talking about GDP estimates needing to be revised lower, that's a very different market mood.
I am curious, though, too, when we talk about expectations for economic growth, and we've seen what the market expects, what economists expect, we've even seen what the Fed expects. It's healthy. Mm-hmm. It may not be, gangbusters, but it seems like a healthy enough foundation. So why is there still some trepidation in the market, particularly when it comes to, like I said, mid caps, small caps, the types of companies that would benefit from a stable economic environment?
Well, I think first on the economic growth expectations is that recession risk has been effectively completely priced out of the market.
I forgot about recession risk.
Does that happen? But also it's been priced out of the psyche. Yeah. If you go back to Powell's comments from a couple of weeks ago, he talked about how great the economy was and how optimistic he was about future growth. So if there's one thing...
Did you believe him?
Well, it does make us a little bit nervous if we're not considering any kind of downside risk, mostly as we're starting to see some signs of things like continuing claims last week continue to march higher. When it comes to small caps and mid caps, we have to acknowledge that it really is about the balance sheets. It's about interest rates being so high, and that there was this notion of survive until 2025 because Powell is going to bail you out. We're going to get interest rate cuts. If those don't come, then we have that balance sheet interest cost pressure that remains.
So in the realm of stocks, if I say the word value to you, what does that even mean right now? Is there value to be found in this market?
Value isn't necessarily dirt cheap at this point, but we do know that the relative performance has been so abysmal that it's likely primed for some kind of snapback. Jeff DeGraff pointed out this morning that the value relative performance has been in the about 6th percentile, so very, very depressed. The question is, does that start to rotate in the other direction that is sustainable? And that's where it comes back to earnings, meaning that you can see a snapback in value simply because it's underloved and underowned, but is that snapback lasting more than, let's say, 2 weeks? And that really is when it comes down to the earnings line, because those have to deliver for it to be more than just a flash in the pan.
Speaking of value, a lot of investors have been trying to rotate out of those high flyers, those big tech stocks, out of NVIDIA, for example, and take on...
Not NVIDIA.
Not NVIDIA. You have seen some of that pullback here and there, but, if you think about the way that people are rotating, there is not a consensus. You've seen that small cap trade. You've seen some value. You've seen some rotation into different sectors as well. How do you play it? What is the most sustainable rotation at this point?
We think it's the steady hand of quality that remains still very, very important. Over the last 4 months or so, you've seen a big surge in low quality, high beta, high momentum kinds of names. And so we do think that the best way to be able to take advantage of these rotations is to continue to focus on things like high free cash flow, good return on invested capital, good balance sheets. They're getting left in the dust a little bit recently, but we do think over the long term that quality is the way to go.
It's people pulling out their EQS screens on their Bloomberg terminal and running those terminal charts. Hey, listen, do you want to go back to something you'd said earlier about GDP growth? Because so many investors are looking here at the way the Trump administration will tackle, of course, the reorganization of the government. Now we're talking about DOGE more and more on this program, aren't we? And do you believe that that could cut into growth if we don't see the same type of fiscal stimulus that we've seen the last couple of years?
I think it's a really important point, which is that fiscal has been a big contribution to overall GDP growth. And so if you start pursuing something that looks like austerity, it might be beneficial in the long run if we want to talk about budget deficits and balanced budgets. But in the short run, there is pain that you have to have for that gain. So it could be that if we actually are able, and that's a big if, to rein in some of the spending and do some reorganization of government, that could detract from overall GDP growth. We saw that the last time we went through a balanced budget kind of outlook. Post-sequestration, it was a drag on growth. So it is an important watch point.
Yeah, and it's a good point, too, because I think a lot of people kind of forget just how much government spending contributes to the growth of the economy. And it gets to this idea as well about the kind of bifurcation, how you have kind of a higher-end consumer, if you will, higher-income people, I should say, that appear to be doing well. You have people in the middle and the lower end that, at least anecdotally, still seem to be struggling. And there was some interesting data that we just got out today about credit card delinquencies rising, particularly amongst lower-income folks.
It is still very present that we have this K-shaped economy. And if you think about the lower income consumer, they're sensitive to things like interest rates. They're far more sensitive to inflation, and they're more sensitive to the job market. So the fact that you're seeing hiring start to slow down, that likely is what is creeping into those issues that we're seeing with the delinquencies for the low-income consumer. Then if you shift to the high-income consumer, that's where we think the equity market is really important, because that's been one of the things: loose financial conditions, high interest rates, yet really strong stock prices, strong housing prices, has led to the high-income consumer being so resilient. And good to remember, the top 20% of consumers make up 40% of overall consumption. So they outpunch their weight. And so if you start to see equity market weakness, and that's an if, but if you start to see it, that could be one thing that could cause that high-income consumer to begin to pull back.
I should just point out, I did my economic part this holiday season. I haven't seen my credit card statement yet, but I'm sure it'll make me weep when I get it.
Yeah, I'm not excited to see it. The holiday seasons are always tough. You know, the credit card delinquencies are a great point. The other reason to look at them is because weeks away we have earnings season starting once again. And if you're starting to see credit card delinquencies rise, do you start to worry about the banks again, or do you shrug it off because the yield curve is steeper and rates are staying high?
Yeah, it's a really good question, is that there's also this notion that the banks are going to see the benefit of a big IPO and M&A cycle. That could be a bit of a hope. We are seeing good performance out of recently IPO'd stocks, at least over the last couple of months. So maybe that's something that can defrost the ice that has been present for the last 2 years within that part of the market. But I think it is an interesting point, which is that markets have effectively priced out some of this credit risk, saying that the economy is strong, so we don't need as much compensation for credit risk. But you're starting to see some pockets of weakness. And if rates remain high, we can't forget that you have a big refinancing cycle that starts in 25 and into 26. And maybe that starts to pinch some of these borrowers.
All right, Cameron, I'm going to have to leave it there. No better way to close out the year than a conversation with Cameron Dawson, the CIO over at NewEdge Wealth. All right, let's get you an update on some of the big stories moving around the cycle this morning. Shnali Bassick with our Bloomberg Brief.
The U.S. economy defied expectations and remained solid this year despite uncertainty around the presidential election, elevated interest rates, and a cooling labor market. The American consumer was the main driver of the economy's resilience, with household spending advancing 2.8% in 2024, supported by wage growth and household wealth. However, cracks have emerged, including struggling housing and manufacturing sectors, rising delinquency rates, and stalled progress towards the Fed's 2% inflation target. Watching gold heading for one of its biggest annual gains in the century, nearing a 27% advance that has been fueled by U.S. monetary easing, sustained geopolitical risks, and a wave of purchases by central banks. Other metals have had a mixed year, with base metals seeing modest gains, iron ore tumbling 28%, and lithium experiencing a second annual decline. Also watching Elon Musk making waves as he weighs into international politics. The world's richest man doubled down his support for the far-right alternative German party 2 months ahead of the country's elections. Musk wrote the party was the last spark of hope for Germany in an opinion piece in a German newspaper. And that's your Bloomberg Brief from me.
All right, we're also keeping an eye on former President Jimmy Carter.
Jimmy Carter stands as a model of what it means to live a life of meaning and purpose, life of principle, faith, and humility. I see man not only of our times, but for all times. Someone who embodied the most fundamental human values we can never let slip away.
A reflection on the life and legacy of Jimmy Carter. That's coming up next. You're watching Bloomberg Surveillance. Welcome back to Bloomberg Surveillance. A quick check on what's going on in the markets today. Asia stocks down, European stocks lower, and U.S. futures right now pointing to a lower open as well. The dollar relatively unchanged on the day. Of course, that is coming right now on what has been a phenomenal year. The dollar against the basket of its peers up about 7% on a year-to-date basis. Crude oil here in New York up about 0.5%. Keep an eye on what's going on in the equity space here. It will be a relatively light week here on the penultimate trading day of the year. Remember, Wednesday is a holiday. Stock markets are closed. The big movers on the day to the upside, VeriSign, to the downside, Boeing. Under surveillance this morning, though, we do want to take a moment to focus on the life and legacy of President Jimmy Carter.
America and the world, in my view, lost a remarkable leader. He was a statesman and humanitarian. And Jill and I lost a dear friend. Jimmy Carter stands as a model of what it means to live a life of meaning and purpose. A life of principle, faith, and humility. I see man not only of our times, but for all times. Someone who embodied the most fundamental human values we can never let slip away.
President Biden among the leaders remembering the life of former President Jimmy Carter. He died on Sunday at the age of 100 at his home in Plains, Georgia. President-elect Trump posting about Carter's death on Truth Social, saying, "While I strongly disagreed with him philosophically and politically, I also realized that he truly loved and respected our country and all it stands for. He called Carter a truly good man who will be greatly missed." That might be the understatement of the day as we reflect on a life that, of course, started 100 years ago back on a small farm in Plains, Georgia, a man with growing up with no electricity, no running water, rising to be the leader of the free world, and a legacy tarnished, of course, from a hostage crisis, tarnished by heavy inflation, but a legacy that was reshaped and I think reimagined over the years as a lot of people look back on his time in office and realize that he accomplished a lot more than maybe what people gave him credit for back in 1980. Kim Wallace, not only covering politics over at 22V Research, but quite the historian himself, about our leaders and about the legacy and how those legacies can change over time, Kim, as we have more time to really process not only what these presidents did in office, but the long-term impact of that. And I'm wondering if you can maybe start with some of those policies that were quite unpopular when Carter put them in place in the 1970s. But over time, we kind of saw the wisdom of what he was trying to do.
Well, in that dynamic, Romain, good morning. I would think energy conservation probably comes to the top of the list. We have now corporate average fuel energy standards that came out of Jimmy Carter's attempt to push back against OPEC using oil as a tool in the middle of the 70s. To various degrees of success, but nonetheless, the man, a nuclear physicist, pointed out that energy independence of the U.S. 50 years ago was an important domestic policy and geopolitical objective. I don't think he gets enough credit for that.
And it's interesting you bring up energy independence, and we are, to a certain extent, energy independent right now, at least when it comes to crude oil. And I do want to bridge the gap between the 39th president and what will be the 47th president with President Donald Trump's inauguration next month, and whether we see a continuation maybe of some of those policies, or at least the legacy of those policies that started under Carter.
Well, you know, President Carter had a lot to deal with. Much of it he inherited, for example, and the inflation that he gets tagged with came from President Nixon's decision to take the U.S. off the gold standard. That devalued the dollar and led to a rapid rise, steady and rapid rise in inflation that Carter attempted to deal with and got politically jabbed for doing so. In terms of energy conservation, you know, it's not now just a aspiration and it's not an objective. It's actually an investment vehicle. And so I think of all the protections coming to what's known as the IRA program, climate science that was passed in 22, is the fact that you have a lot of mayors and governors around the country, particularly in the middle of the country, who support the program strongly because of the investment it's bringing to their areas. And that's going to protect the IRA as we go through 2025. My guess is that both on IRA and CHIPS, something that Carter was aware of, the importance of manufacturing, particularly in the shipbuilding area, going back to his naval career, those things will be debated during the tax policy conversation, not before.
Some of the aspects of what he put into government while he was there includes also, speaking of energy, the Department of Energy, as well as the Department of Education, a department that the president-elect has previously pledged to eliminate. When you think about the organization of government moving forward, what from the Carter era remains moving forward? And are there pieces of it that you see being chipped away?
You know, good morning, Sanala. My sense is that it's underappreciated again that the Bureau and the budget became the Office of Management and Budget in part because of Carter's push to professionalize fiscal policy at the executive branch. In terms of what would be lasting, my guess is that people will remember the attempt at price controls. And that probably has historical lessons to it, both in classrooms and in the economy overall. Again, people focus a lot on the failed Iran hostage crisis, but they don't focus as much on Carter was the first president to extend formal diplomatic relations to China, and the Camp David Accords, of course, helped at a time in the Middle East, something that remains in the headlines, in a way that was a very personal negotiation by him and two other heads of state.
What would another Camp David Accord look like today? Do you think such a peace accord could be accomplished with the divisions that we're seeing now?
Oh, I think so. I benefited from a trip, a week-long trip to the Middle East last spring. I was struck in speaking with a lot of asset allocators, other types of investors, both portfolio and direct, at the impulse of capital to geopolitics in the region now. This is, of course, the UAE, Saudi Arabia, Qatar. My sense is that the accords, the Abraham Accords that then President Trump got going and President Biden followed through on or attempted to, still has life to it. That what's happened in the Middle East in the last 6 months has been shocking, frankly, and resets opportunities in the Middle East, and the regional players there are much more interested in growing, accumulating, allocating capital than episodic war. My sense is that in the first half of next year, there'll be another opportunity, clearly, after a lot of death and destruction, regrettably. There'll be an opportunity to reset the Middle East among the 3 or 4 major players in the region away from these hostilities.
All right, Kim Wallace over at 22V Research. We'll catch up with you in 2025 to look at the life and legacy of former President Jimmy Carter. When we come back, we're going to take a closer look at the world of artificial intelligence. A conversation up ahead with Parmi Olson. She's the author of the book Supremacy, AI, ChatGPT, and the Race That Will Change the World. You're watching Bloomberg Surveillance. A bit of trepidation heading into the year end. This is Bloomberg Surveillance. Romaine Bostick alongside Sonali Basak, filling in today for John, Anne-Marie, and Lisa here on Bloomberg Surveillance. Let's take a quick check of the markets in Sonali. We're seeing S&P futures looking like they're setting up for what is going to be potentially a third straight day of declines. But of course, that kind of belies the fact that it's still sitting on monster gains on a year-to-date basis, more than 20% for the S&P, 30% for the NASDAQ composite. And we talk about some of the individual movers on the day. VeriSign, that's your big gainer in the pre-market trade. Boeing, your big decliner. And take a look at what's going on in the Treasury market, Shonali. A 10-year yield at 4.6. If you had told me we would be at 4.6 a few months ago, I would have said not a chance.
A 3 basis point move lower on the day, at the very least, but you have a bid back just a bit. But yes, 4.58, just incredible, the stunning moves we've seen there. The 30-year even more so, almost at 4.80, Romaine, if you could believe it.
Most of the price gains right now in the Treasury space have been erased on a year-to-date basis. Not necessarily so in the FX space. The dollar having a phenomenal year up against a basket of its peers. 7% on a year-to-date basis, up fractionally versus the euro here on this Monday morning in New York. We turn our attention now to the world of artificial intelligence. Of course, it really burst onto the scene, at least publicly, back in late 2022 with the release of ChatGPT. Our next guest, Parmi Olson, she's the author of a book called Supremacy, AI, ChatGPT, and the Race That Will Change the World. And she notes that the speed of AI adoption in the tech industry is phenomenal, writing that generative AI promises to make people more productive and bring more useful information to our fingertips through tools like ChatGPT. But every innovation has a price to pay. Parmi joining us right now to, well, I guess talk a little bit about those prices. And Parmi, I do kind of want to start out with the evolution of this. And I know AI has been in development for years, if not decades. And for most of us, we only kind of came to our attention just 2 years ago. But I was talking to a big Silicon Valley investor, and he was kind of reminiscing about the internet age and even sort of the computer age back in the 70s and the 80s, and how it really was just a bunch of ragtag researchers, people truly in their garages creating this stuff. And he compared that to today, where it's not really about sort of that garage innovation. It is about Microsoft and Alphabet and NVIDIA, the big heavyweights, multi-billion-dollar companies, trillion-dollar companies that are really driving this. Why?
Yeah, and I think it's so interesting to make that comparison with, for example, the dot-com boom or even the original computer boom from the 80s, because, as you say, these were tinkerers, these were people in their garages, but now a lot of the so-called innovation, and it is innovation, is coming from companies that are incredibly well-resourced. We're talking the largest companies in the world whose market caps are in the trillions of dollars, like Microsoft, like Google, or Microsoft as a proxy for OpenAI, which has a 49% investment from Microsoft. And ultimately, what that means is that when people talk about AI hype and whether we're in an AI bubble and we're going to see some kind of crash, my view has been, yes, there has been a lot of hype and probably overhype, but I don't think we're going to see a big burst or a big crash, because unlike with the dot-com boom and bust, this new kind of revolution in tech is being driven by companies with huge balance sheets, tens of billions of dollars, and they can afford to keep investing in this very expensive technology for quite some time. So I think we're going to continue to see this build out, including into 2025.
So what does AI end up looking like? What is the end product? I mean, in your book, I mean, you spent a lot of time talking about Demis Hassabis over at DeepMind, Sam Altman over at OpenAI, the competition between them. But what I found most fascinating about the storytelling amongst those two characters in the book was just kind of the divergence in their opinion of what AI should be. And I feel like that seems to be the big challenge right now, is you have two overarching competing visions of what AI should be.
Yeah, and the divergence, in my view, is between how these visionaries, in my view, the two most important builders of AI are Demis Hassabis, the founder of Google DeepMind, and Sam Altman, the founder of OpenAI. And these two guys in charge of these two companies have essentially been trying to build artificial general intelligence. That's their ultimate objective, which is AI that kind of surpasses the cognitive abilities of humans. But they started out with explicitly humanitarian goals of building this ultimate godlike AI system that could help solve a lot of economic and societal problems, cure cancer, solve climate change, bring economic abundance to everyone. But what ended up happening, and what my book explores, is this kind of divergence away from those goals as these builders decided, well, the ends justify the means, and in order for us to actually build this technology, we need to align ourselves closer and closer to these incredibly large technology companies and build this AI as a product for these businesses, and sort of be driven by the financial incentives of those companies.
Aligning with capitalism more closely. OpenAI mulling a plan for a for-profit business then. What do you make of that? Does that create a way for more people, more investors, potentially even retail investors, and maybe a potential future one-day IPO to be involved? Or does it take it away from its initial mission here to be a nonprofit, to be for the better good rather than for the sake of money?
Well, it absolutely does both those things, because OpenAI started as a nonprofit and it wasn't getting investment, it was getting donations. And nobody wants to donate hundreds of millions of dollars for this possible godlike AI that could bring economic abundance to everyone, as Sam Altman has insisted it will do. And that's why a few years after OpenAI's founding, he realized actually building AI, generative AI, as we call it now, is so expensive. He needed to get investment, and so that's why he took investment from Microsoft and is now taking investment from other big players, including SoftBank and Masayoshi Son. And so, I mean, it's really interesting to hear you say IPO. It's almost like nothing is really off the table now. I think one area they're looking at is particularly restructuring themselves as a public benefit corporation. So that's maybe one way they can kind of toe the line between capped profit, as they were, and for-profit. But ultimately, the original objectives that they were chasing have just kind of faded into the background as they become much more product-focused and business-focused.
Where does their responsibility lie at the end of the day? I'm very curious of what you make into Meta's approach to AI, this idea that open source AI is the better way to go about the model, as opposed to the way ChatGPT and OpenAI deal with their own systems, more closed off. Is there a dominant model here, and will one make one company more successful than the other at the end of the day?
That's a great question, and actually that's really what I wanted to explore with the book, is that both Demis Hassabis and Sam tried to start off or build nonprofit versions of their organizations, and both failed. And they were really trying to put in responsible oversight and governance of this very powerful technology. And what I wanted to show to a mainstream audience through the book was that ultimately we still haven't figured out how to balance innovation and oversight and good regulation of this kind of transformational technology. Now, open source, as Mark Zuckerberg and Meta is trying to chase now, is a really interesting kind of third party or third approach to sort of providing AI sort of democratically to people through free open source software. The question is whether it is actually open source. There are some real debates about whether the Llama model that Meta has let out is actually technically open source. And if you actually look at the most recent versions that it's put out, they have become increasingly restrictive in their terms of use. And there are also a lot of questions about misuse of these kinds of models. If anybody and everyone can use them, they can't be policed.
Well, that's what I'm curious about. I mean, you used the word oversight a little earlier, and I actually kind of chuckled inside, because I don't know where the oversight is. And I do worry that the industry is so far ahead of regulators right now, and we know regulators are always behind, but I feel like the pace at which we're seeing development in this space relative to the lack of pace that we're seeing in regulatory oversight, like, what does that mean for us? I mean, we're going to end up with a powerful technology controlled by a small group of billionaires, and a technology that I'm told can do a lot of things that humans can do. Replacing, I don't even know. I assume you're real and not AI this time around, Parmi. But the fact is that I might not know that, and a lot of people might not know that. When do we get the guardrails that can assure us that what we're interacting with is what we're expecting to be interacting with?
Yeah, I know. And to your point, just in the last few weeks, as people have been talking about a potential slowdown in AI development, OpenAI has released a new model called O3, which people in the AI community are really excited about and are saying, well, this is a whole new level of benchmarks. AI models can now do reasoning. They can take action. And so I don't think you can just assume that AI isn't going to continue to move so quickly ahead, even into next year. I wouldn't discount regulators. I do think the European Union's Artificial Intelligence Act was put in place even before generative AI came on the scene with ChatGPT, and it's got a lot of quite good ideas about how to deal with the potential risks that technology can cause. And it's not regulating the technology, it's the companies, and it's getting them to do risk assessments on their technology and to be more transparent, which I think has been a problem.
Yeah.
But taking that 10,000-foot view, as you said, this technology is being controlled by just a handful of billionaires. That's absolutely true.
Yeah.
It is just a few people making decisions about these models that are kind of incredibly fluent, human-like. They're being plugged into education, in legal firms, in healthcare,
Yeah.
and there just aren't really the checks and balances that you would expect for something like that, or critically, the transparency about how these models are being built.
I am curious. I'm going to ask you a kind of a loaded question here, Parmi, and this really has to do with how viable this technology is. I know what I'm being told, but there always seems to be out of Silicon Valley a little bit of sleight of hand when it comes to these technologies. They always kind of overpromise what these things can do. And I think back to your days before you came to Bloomberg, you were at the Journal. You wrote a lot of great stories about artificial intelligence, AI capabilities, and some of the exaggerations coming out of those AI labs, including over, I believe, at Google, if you correct me if I'm wrong. And I'm wondering if maybe investors should at least be mindful that we could be seeing some of that again without throwing in allegations around. Like, how much should we look at that from that perspective?
I think absolutely. When investors are looking at where to put their money and how much of an impact is AI really having, don't just listen to the tech companies. Talk to the businesses, talk to the law firms and the hedge funds and the investment firms and the education firms and just find out how are you using this, the PR firms. And a lot of companies are using these models. To the extent that that shows up on their earnings report as perhaps an increase in quarterly EBITDA, it's hard to find that correlation to where I've just paid a subscription to OpenAI's new model, and that's translated into kind of a return on investment. That's the big question for both tech companies and their customers. It's so difficult to actually measure ROI on this stuff. But I think that's something we're figuring out, we'll continue to figure out over the next year, is really pay attention to the people who are using the technology, not just the tech companies, as they're very good at spinning stories about how transformative their technology is going to be and AI will be. And I do believe it will be transformative, but not across the board, not for every industry and every company. Some certainly way more than others.
Parmi, how far are we out from that holy grail of artificial general intelligence?
Yeah. Oh, gosh. There are some people who don't even subscribe to the idea of there being a threshold for artificial general intelligence. I'm not entirely sure where I stand on that because I believe that artificial intelligence as a term has become a marketing term. And I imagine AGI will also be used as a marketing term. And no one actually has a very clear definition of what that's going to look like. Some companies and researchers have put out papers trying to define that, but there is no broad consensus on what that's going to look like. And so I can imagine companies will proclaim themselves as perhaps having invented something that looks like AGI when maybe it isn't. There might be a lot of debate when we eventually get to that point. Some people are saying it's 10 years out. Demis Hassabis of Google DeepMind has said it's coming in the next 5 to 10 years.
Yeah.
Some people have said 20 to 30 years. I wouldn't want to put a number on it, but I would just be very wary of people proclaiming it as being here, given how much the term AI has been so overhyped and used as a marketing term.
All right. Well, Parmi, this is a great book, and you're a great columnist now, of course, with us here at Bloomberg. I'll be interested to see the follow-up to this book maybe in about 10 years' time or so, or whenever we get to that next threshold. Parmi Olson, author of the book Supremacy on the Future of AI, or really on the race to build AI. And it was kind of interesting. Now this is becoming a little bit more in the zeitgeist. I saw an interesting story put out by our folks at Bloomberg Government saying they expect the next proxy season for companies is going to have a lot of questions on here about artificial intelligence and whether companies should be protecting their workers or protecting even their clients with more safeguards.
Really interesting here because, of course, proxy season, it seems, is always upon us. And there are large investors, including New York State's own retirement fund, that are taking a look at AI-related disclosures. In particular, Tom DiNapoli, of course, the comptroller of the state. Many companies are deploying AI without adequate safeguards, many transparency issues as well, governance frameworks, ethical guidelines. even with this ESG pushback you're seeing, you could still potentially see that G part, the governance part, still see a lot of heat when you think about shareholder activism coming into next year.
Absolutely. It'll be interesting to see, of course, a lot of these proxy battles sometimes go nowhere, but of course, this is a big issue, front and center for both investors and users alike. So something to keep an eye on as we head into the proxy season in 2025. Meanwhile, here on the penultimate day of 2024, let's get you an update on some of the other stories out there this morning. Here's Shanali with our Bloomberg Brief.
Romaine, this morning we are remembering, of course, Jimmy Carter, the 39th president of the United States, died on Sunday at the age of 100. The longest living U.S. president, Carter's accomplishments during his one term included brokering a historic peace accord between Israel and Egypt. After leaving office, Jimmy Carter founded the Carter Center and was awarded the Nobel Peace Prize in 2002 for his efforts to promote peace, democracy, and human rights. President Biden addressing the nation Sunday night from St. Croix, calling Carter a statesman and humanitarian. Biden says he'll order a state funeral for the former president in Washington and designated January 9th as a national day of mourning. The U.S. stock market has traditionally closed on the day of presidents' funerals. Along with President Biden, President-elect Donald Trump paid tribute to Carter on social media. While Trump often spoke negatively about Carter's presidency during the campaign, he wrote on Truth Social yesterday that Carter did everything in his power to improve the lives of all Americans. For that, we all owe him a debt of gratitude. That's your Bloomberg Brief from me.
Thanks to Shanali, and we will continue our focus today here on the life and legacy of Jimmy Carter. But before that, when we come back, a closer look at the Fed's path forward.
In the early part of the year, the Fed is going to wait to see what happens with policy, with tariffs, with immigration policy. They'll look at the growth rate of the economy, and they will wait.
That story is coming up next here on Bloomberg Surveillance. A deterioration in S&P futures here on this Monday morning. The S&P 500 setting up for what could be a third straight day of declines. When we started this show just a little while ago, Shanali Basak, futures were only down about 0.1% or so, but you see the deterioration there. Boeing, Shanali, one of the biggest decliners in the pre-market trade.
Yeah, with a nearly 1% decline in S&P futures. Tough tape out there. Of course, you are seeing that bid back in the bond market, so you can't blame the 10-year for today's sell-off. Of course, it's thin trading volumes on a holiday week. We do have a day off this week, but again, tough month to end on.
And if our viewers are confused as to why Shanali and Romaine are talking to each other, John Farrell, Lisa Abramowitz, and Anne-Marie Hordern, for some reason, all got this week off together. I'm not sure exactly how that works, but Shanali and I will do our best to keep things moving here. And under surveillance this morning, we are focusing on inflation and the Fed's path forward.
In the early part of the year, the Fed is going to wait to see what happens with policy, with tariffs, with immigration policy. They'll look at the growth rate of the economy, and they will wait. They can afford to wait. There's no reason for them to rush ahead to lower rates anymore, and they have good reason to regret, shall we say, having lowered rates as much as they have.
Chuck Lieberman there, of course, a legend on Wall Street, talking about the positioning in markets right now. And you see the positioning here on this day in the Treasury market. Yields down. And we talk about the moves that we've seen on a price basis. Treasuries right now have erased almost all of their price gains on a year-to-date basis, despite IMF projections that the U.S. economy is actually set to be the top performer among G7 countries. Inflation, of course, was the big story in 2020, 2021, and that story turned into one of deflation in 2023 and 2024. Thomas Urano of Sage Advisory writing in a note that yields are priced for Trump 2.0 and a Fed to stay on hold. Starting yield is the best indicator of return, suggesting an income return of about 5% for 2025, with price performance potentially adding to that. Thomas joins us right now here on Bloomberg Surveillance. Let's talk a little bit more about that. I mean, we talk about the Fed tightening cycle. We talk about the Fed easing cycle. And now I guess a lot of people are wondering as to whether that's it, whether we got all we got and the Fed pretty much stands pat for a good chunk of the year.
Yeah, the Fed's done a good job of repricing expectations moving forward. I think in anticipation of what I described as Trump administration 2.0, right? This is an administration that's focused on taxes, tariffs, and immigration policy, all of which are aligned with this idea of this inflationary pro-growth environment that's designed to get the economy moving faster. However, that puts inflationary pressure back on the table. So I think with that backdrop, the Fed needs to align investors' expectations for a potential pause in the idea of cutting rates. Let's sit back and let's see how the administration gets policy enacted, and let's see how the economy responds to that policy.
So what does this mean in terms of risk appetite that investors are willing to take? Because traditionally bonds have been a diversifier in that 60-40 portfolio that has broken down as of late. And instead, you've seen investors hiding out in cash to a large degree, which have often yielded better returns than even parts of the shorter end of the yield curve. Where do you go from here? At what point do you start to take on duration risk in the bond market that has failed to deliver?
That's a great question. And I think as we look forward, there's a couple things to take note of. Number one, let's look at where the market's pricing itself, right? That gives us a good baseline for consensus expectations. Number one, the December 2026 futures contract, SOFR futures, trades at 405. That's consistent with one more Fed cut over the next 2 years, right? So effectively, the market is priced for the Fed to be on hold. The 10-year note has been putting in some of the highest term premium we've seen over the last decade. That's the result of volatility and inflation risk. So this suggests that yields are fairly priced for this idea of a new Trump administration with potential pro-growth but inflationary policies in place. That being said, what we've seen is that the yield curve has been steepening. That's adding some positive slope, and to your point, that's adding a little bit more yield advantage than sitting in cash. To that end, where do you go in 2025? There's some ideas here. You could look at high income sectors in the bond market to generate income in a scenario where maybe policy goes sideways and the Fed doesn't cut rates and there is no price appreciation. In that scenario, let's look at loans over high yield. Let's look at mortgages over investment grade. Bank preferreds generate a pretty nice yield. So I think 2025 needs to be a scenario where you're looking to generate as much consistent income as you can.
All right, Thomas Urano over at Sage Advisory. We'll catch up with you again in 2025. A closer look here at the inflation picture, the fixed income picture, and of course the Fed. And I don't know, we know that this is going to be a big theme for 2025. The Fed is always a big theme here. But should investors still be concerned about inflation?
That's the big question. You don't know what the policies are going to turn out to be ultimately, whether it's posturing on a lot of the tariff policy or whether it'll be real. The other element of this is how risky are you going to be as an investor? Yeah. Are you willing to short the long end, short it with leverage, let alone? There are definitely some of those players out there right now.
Not in the fixed income space. I feel like that's just been that trade has backfired so many times in 2024. Like, why would you go back out on that limb unless you really had some insight into some big exogenous shock coming?
You have had a full percentage point added back to the 10-year from the September lows. It's just an incredible move and sometimes violent.
And we didn't get a chance to ask him about, the fiscal situation. But, there was a great column earlier today by Dan Moss talking about this idea of dollar dominance and how that is going to be the protector maybe against some of the fiscal issues here. It'll be interesting to see if that plays out. We've been here before.
We've certainly been here before, but of course, maybe it's a conversation ahead into tomorrow and into 2025 because it's not going away, that dollar dominance, Romaine, and a lot more coming up right now for you.
A lot more conversations coming up, including Stovall at CFRA and a conversation about crypto.
Market is seeing that the economy is not weak.
I would argue we've had a broadening out.
I think markets are still really euphoric.
You need some conviction. You need that to really anchor you because we're going to have a lot of volatility.
I think we're actually going to get off to a bit of a sloppy January.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
Good morning to our audiences worldwide. This is Bloomberg Surveillance. Romaine Bostic here in our Bloomberg World headquarters in New York, joined alongside Emily Grafeo for this hour. Emily, happy holidays to you. Great to see you.
Yeah, thanks for having me.
Not necessarily a great day for the markets, a great year for the markets, but on the back foot, you're seeing a deterioration once again in S&P futures. It's going to be a third straight day of declines as we get ready to close out the year.
Yeah, I thought that stocks were supposed to go up after Christmas in a Santa Claus rally, but it doesn't really look like that.
Yeah, it looked like the Santa Claus rally started off on a good foot, and of course, the last 3 days, or at least last 2 sessions, has been on the back foot, and today it looks like more of the same. As far as some of the big gainers and some of the big decliners on the day, keep an eye on Boeing. Those shares down more than 3% here in the pre-market. Some concerns here about that airline crash in South Korea. VeriSign, one of the big gainers to the upside, and that's because Warren Buffett, Emily, keeps increasing his stake in that company, or Berkshire Hathaway, I should say. I don't know if you're a big VeriSign fan or not.
No, but what does Warren Buffett know?
I don't know. He must know something. I'm told he's a pretty smart guy. He's made a lot of money over the years. Meanwhile, we check in on what's going on in treasuries. A slight move in yields here, a slight uptick in the VIX. The dollar relatively unchanged as a lot of people really try to pull together everything that's happened this year, Emily, and try to figure out whether that's going to continue into next year. You got a price target for next year on the S&P 500?
Romaine,
I'll put you on the spot.
I am not allowed to make price targets. I am a real journalist. I have no opinions.
All right, well, our next guest is allowed to make those price targets. Sam Stovall over at CFRA, talking about investors potentially trimming risk to close out this year. We're going to hear from him in just a second. We're also going to hear from Perianne Boring over at the Digital Chamber to talk about her outlook, and it is a bullish outlook for crypto in 2025. And Patrick Haan over at GasBuddy on the holiday travel season and what's next for the oil and gas markets under a second Trump administration. But we begin our hour here with the top story of the day, and that is equity futures here in the U.S. moving lower this morning, with investors dialing back just a little bit here on the risk side here in the final 2 days of 2024. Sam Stovall over at CFRA expecting volatility to lead to modest gains for the S&P 500, a year-end price target right now of 65.85. Stovall writing 90% of the year one presidential cycles endured declines averaging greater than 17%. Three-peats after down years, well, that's only happened only 20% of the time since World War II. Sam joins us right now to talk about his expectations. And we'd be remiss in not pointing out, Sam, that expectations coming into 2024 were a lot lower than where we ended up here at the end of December. And I guess I wonder whether expectations heading into 2025, in your eyes, are either too bullish or too bearish or maybe just about right.
Well, Romaine, first off, Happy New Year in advance to you. I think that they might be a little bit ahead of themselves. While I do think that we're headed for a good year, I don't think we're going to end up with a great year. Another aspect to consider is that we are in the third year of this bull market. And of the 11 bull markets since that celebrated their second year, we only saw about a 2.5% price appreciation in the subsequent year, with 3 of those bull markets becoming bear markets. So there's a lot of volatility, a lot of potential for investors to take the money and run, and we'll have to see what happens.
I am curious. Bloomberg survey of strategists that we just did earlier this month showed that most people expect the S&P on average to reach about 6,600 in 2025. But you had some estimates that were at 7,000 and above, and that's a pretty big rally. We're talking basically about 15 to 20% rally to get to that level. And it raises the question, Sam, that in that bull scenario, what exactly drives that? Is it just going to be about earnings? Is it going to be about economic conditions? What gets us there, if at all?
Well, I think what would get us to a double-digit advance would be that we do end up with 13+% growth in earnings, as is currently projected by Wall Street, that we do end up seeing GDP growth continue to remain above trend at about 3% or so, but we actually find that the rate of inflation turns around and starts to head lower once again, and that the Fed is pretty close to its target by the end of 2025, and as a result of being in anticipation of that trend, resumes its rate-cutting program, and we end up with more cuts than the 2 that are factored into markets now.
So, Sam, what happens if that doesn't all play out? What if we don't get the 2 rate cuts that the Fed is now projecting? Does that really dent the stock market's progress for 2025?
Well, Emily, I do think that it ends up being a headwind. As Romaine had mentioned earlier, 90% of the first-year presidential terms ended up having declines of 5% or more within them, intra-year declines, and the average being a little more than 17%. There is a reminder, however, that of the 80-plus declines of less than 20%, we got back to break even in an average of only 4 months. So if we get the digestion of gains out of the way before the end of July, history basically says we end up with a positive year. So I think that there will be a lot more volatility as investors attempt to assess what the Fed will be doing next. But if you do take away a lot of the potential tailwinds, then that only leaves the headwinds and could make for a challenging year.
What about on the sector level? Is this going to be just another year that tech powers higher, or do you see that market rotation, maybe the equal weighted S&P 500 coming out above?
Well, from a valuation perspective, yes, I could see reasons why investors would want to go for the equal weight 500, because right now it is trading at only a 1% premium to its average PE over the last 10 years, whereas the S&P cap-weighted 500 is trading at a 21% premium. And if you look over the last 20 years, the S&P 500 is trading closer to a 35 to 40% premium. But history basically says, no, following a good year, following an up year, you want to let your winners ride. And going back to the early 1990s, if you own the top 3 sectors from the prior year, carried them into the coming year, you beat the market by an average of 300 basis points per year, and you did so 75% of the time. Obviously not a guarantee, but it usually says that if these sectors are leaders, it's for a reason.
I do want to sort of fold in this idea of it being the first year of a presidential cycle, and that always kind of has an effect on markets. There are a lot of people drawing parallels to 2016, where we had that huge Trump rally kind of right around the election. Then, of course, it kind of stalled once he actually came into office, at least for the first few months there. And whether we see a repeat of that, given how much this market has appreciated since late October into mid-December.
Well, that certainly is a possibility. Again, looking at historical precedent, if you look to what I prefer being the January barometer, as goes January, so goes the year, something I learned about from the Stock Traders Almanac. Add that to the first year of a president's term in office. The first year plus a up January has led to a rise in the market 91% of the time since World War II, with an average gain of more than 18%. So yeah, I could see that we end up sort of pausing just after the inauguration, because we want to wait to see what the president will end up enacting in terms of tariffs, price, tax cuts, et cetera. But there could be a good end to the year if we do start off on the right foot.
All right, Sam Stovall over at CFRA. We'll catch up with you again in 2025, a closer look at the equity markets. And Emily, we talk about an equity market that has been, well, let's just say concentrated amongst a few big winners this year. But it's not just crowded trades out there. It's also crowded forecasts. I was looking at the S&P forecast by strategists that we've surveyed. And there was an interesting story on the terminal talking about how clustered a lot of these predictions are among certain percentage levels.
Yeah, I guess it doesn't really pay to move outside of that spectrum. But it's interesting because I was reading another story on the terminal that said that by late January of 2024, most of the Wall Street strategists had already had to revamp their S&P 500 price targets and bring them higher. So it just feels like every year, at least for the last few, people have not been bullish enough.
And just to put that into perspective, we came into this year, based on the Bloomberg survey, with expectations for a median gain to 4,800 on the S&P 500. We're just below 6,000 right now. So obviously a lot of people are wrong. And we should point out the highest estimate in that survey that we did December of last year, the highest estimate was for the S&P to finish out the year at 5,200. So no one even came close.
So the highest for 2025 is now 7,100.
All right, well, we'll see. So that means we should bank on what, like 8,100 or something?
9,000.
All right, well, we'll have to wait to see. Of course, not much action here on this day with S&P futures in the red. We do want to update you on some other stories floating around this morning with our Bloomberg Brief. And we start with the infighting in Congress and Republican pushback on GOP House Speaker Mike Johnson. Some party hardliners haven't committed to re-electing Johnson as Speaker after he backed a temporary spending deal that didn't include President-elect Donald Trump's initial demand for lifting the U.S. debt ceiling. But others in the party, they're pushing back on calls to remove Johnson. President-elect Trump himself hasn't taken a public stand on Speaker Johnson's future. The House speakership vote, based on constitutional law, is scheduled for January 3rd. Gold, heading for one of its biggest annual gains of the century. The 27% advance right now, that's been fueled by U.S. monetary policy easing, sustained geopolitical risk, and a wave of purchases by central banks. Other metals, though, they have had a mixed year, with base metals seeing modest gains, iron ore down 28%, and lithium experiencing a second annual decline. And Peru has closed ports and public beaches as rogue waves as high as 13 feet battered the South American coastline over the weekend. Local news networks saying fishing has been disrupted as strong waves overturned boats near Lima. Peru's National Center for Emergency Operation saying 91 of the nation's 121 ports would remain closed until at least January 1st. That is your Bloomberg Brief. Meanwhile, when we come back, we are going to talk about a phenomenal year for crypto and a guest who says that next year could be even better. The Digital Chamber CEO, Perianne Boring, previews what could be a major year ahead. That's coming up next, right here on Bloomberg Surveillance. Welcome back to Bloomberg Surveillance. Romaine Bostick alongside Emily Grafale. Emily, stock futures right now on the back foot, setting up for what could be a third straight day of declines for an S&P 500. An S&P 500, we should point out, that's still sitting on year-to-date gains of more than 25%. You see the euro dollar right now relatively unchanged on the day. Your 10-year yield moving slightly lower, actually now starting to pick up steam, down about 6 basis points below that 4.6 level. The VIX slightly elevated. Crude oil getting a modest bid on the day. And of course, the big story of the year, not necessarily the big story on the day, that has to be cryptocurrencies. Bitcoin unchanged on the day, but of course, a little bit earlier, it did make that phenomenal run to about $106,000. More than doubling on the year, and that comes after more than doubling the year before. And a lot of people looking at these record-breaking rallies and wondering whether it could cool significantly as investors really try to assess the impact of a new administration coming in, an administration that has promised to be supportive of crypto. Perianne Boring is at the Digital Chamber, which are one of the main groups in Washington lobbying on behalf of the sector. She's saying that with the new administration coming in, quote, the war on crypto is over, saying this administration prevents transformative opportunities for crypto adoption, leveraging executive powers to implement impactful policies. Perianne joins us right now to talk a little bit more about that. And we talk a lot. I mean, there's always, I'm sure you've heard all of the criticism that there really is nothing fundamental driving cryptocurrencies. And, you know, I don't know if that's always been true, but it's certainly going to change next year as we have a lot of policies, at least policies that were promised on the campaign trail by the Trump administration, that at least on the surface stand to be relatively bullish for the crypto space overall.
Well, cryptocurrencies play a very important role in the geopolitical as well as the macroeconomic environment. Starting with Bitcoin, the world's first cryptocurrency, this presents a store of value. And in a time where we have very significant economic volatility all around the world, historically high levels of inflation here in the United States, but in also many other places, having a safe store of value that's a digitally native asset is an idea that this time has come. And that's why Bitcoin is really seeing huge amounts of adoption. Bitcoin is up over 150% this year. It has been the best performing asset class in the world for 12 out of the past 15 years. The fundamentals are extremely strong. But as we mentioned earlier, public policy and politics absolutely drive
what's happening in the markets. And we've had a huge attack, political attack to try to stifle the adoption of Bitcoin and cryptocurrencies. And that is now over with the election of Donald Trump.
Well, let's talk about why it's over. We talk about the lobbying campaign by the crypto industry. They put a lot of money, not so much just into the presidential race, but really a lot of the congressional races as well. They seem to do pretty good. You have a White House administration that appears to be crypto friendly. You have a Congress that, at least on the surface, appears like it might be a bit more crypto friendly. There's got to be follow through, Perianne, on this, though. You can't just sort of say we want to do these things without doing them. Do you think we're going to see that follow through?
Yeah, no, that's absolutely right. And personnel is policy. And if you look within the Trump administration, in the cabinet that he's assembled, there are multiple pro-crypto and pro-Bitcoin people that will be serving in the cabinet, including our incoming Treasury Secretary, Bassett, who's said multiple positive statements about Bitcoin on the record. We have Robert F. Kennedy, who's probably the most bullish candidate on cryptocurrencies in the history of the United States. And then we also have Paul Atkins, who will be our incoming Securities and Exchange Commission chair, who is also very supportive of the space. He serves as one of our advisory board members at the Digital Chamber, and he really knows what policies need to be put in place to help foster the innovation and the development of this technology here in the United States. And then turning to Congress, because Congress is also going to play a very important role in developing that legal environment that will incentivize the private sector's development of this technology here. We have over 290 members of Congress that will be sworn in just a couple of days that ran on pro-crypto platforms. So crypto is the majority party. This is not a partisan issue. We have many, many members from both sides of the aisle that understand the importance of this technology in the United States leading in its development.
You know, Perianne, one of the positions that hasn't been filled yet is the person who's going to be leading the CFTC and their role in crypto. There were some reports about a month ago that you were a contender to lead the CFTC. Is that still on the table?
Well, it's absolutely critical that the CFTC has a pro-crypto person leading the agency. Cryptocurrencies, the majority of cryptocurrencies are commodities. And the biggest issue facing the crypto industry is this regulatory ambiguity, which cryptocurrencies are securities, which ones are commodities. And both those two agencies have issued confusing and conflicting statements on which one has jurisdiction over the crypto space. So President Trump is vetting a number of pro-crypto candidates. That's the extent I'm able to share with you today, but it is critical that we have a pro-crypto leader and someone who is going to ensure that the CFTC is leading that conversation, because the CFTC should be the primary regulator for cryptocurrencies.
I want to get back to Bitcoin specifically, because you have a pretty large price target for Bitcoin ending 2025 at 800K. Tell us about that. What's really going to drive that?
Yeah, and I don't make price predictions because it's impossible to predict the price of Bitcoin. There's so many factors that go into why the price is what it is on any given day. So I really encourage investors and people to look at models. What do the economic models, what do valuation models tell us about what is the value of Bitcoin? And there's a couple that I can reference. Stock to flow, which is over 80% accurate to the historical price of Bitcoin, has a base case of over 800K at the end of 2025. Over the past three halvings, that model has been over 2 standard deviations above its price. So that could potentially be on the higher side, as high as $3.2 million by the end of 2025. Yeah. A couple other models to look at are just a historical price trend. That has that at 190K today. And Metcalfe's Law has Bitcoin at 119,000 today. Again, these are valuation models. These are not price predictions. These are looking at the features and transaction volumes and the historical price price of Bitcoin to see what is the value today. And what the models are showing us is that Bitcoin's actually undervalued, and we still have a lot of appreciation opportunity all throughout 2025.
I'm curious, broadening this out from just Bitcoin, because there is this hope that with this administration coming in that is more pro crypto than potentially the last administration, this idea of where we see a broadening out of the cryptocurrency space or just digital assets overall. There's been a lot of talk about just the whole digital ledger technology might get a boost, and we might see more sort of hard assets sort of being put into tokenization. We might see the creation of new types of coins and things like that. Are you expecting a broadening of the industry beyond just the big tokens that we talk about, like a Bitcoin or something like Ethereum?
Yeah, absolutely. And that's why the SEC and the CFTC are so critical, and the people that lead those agencies are so critical. The reason why we have seen just so many innovations and investors and activity leave the United States is because we don't have regulatory clarity between the SEC and the CFTC. Again, Bitcoin's the world's first cryptocurrency. Its application is a store of value that's very different than smart contracts or building decentralized applications or other distributed ledger models. But Bitcoin's leading the way. These rising tides lift all boats. And this is where that concept of Web 3.0 really comes in. We are rebuilding the internet using blockchain technology, and this is going to impact almost every industry you can imagine, similar to the internet. This allows us to facilitate peer-to-peer transactions in a digital way, and this is going to not only change the financial services industry, but change the way that we share data and things of value over the internet.
You talk about regulatory clarity, one of those being, defining what the SEC is going to be overseeing versus the CFTC. But what else are you thinking about in terms of more regulatory clarity for the crypto industry that we could see in the years ahead? Is it about clarifying or adding more regulations that would be pro-crypto?
Well, clarity is one of the biggest issues. Having these confusing and conflicting statements and speeches and stances from the SEC and the CFTC has just completely stifled innovation here in the United States. So that's really step one. But there's so much more that can be done to incentivize the development of this advanced technology here on U.S. soil. Everything from being able to have a registration process to get more regulated products to market. That all needs to be built at both agencies. Yeah. And then there's other agencies that come into play. IRS is a big one. Tax policy has a huge impact on adoption. So getting a better and clearer tax policy from the IRS is also a big priority of the incoming Trump administration, is something that can encourage the adoption of cryptocurrency.
All right, Perry-Ann, you have to leave it there. Perry-Ann Boring over at the Digital Chamber, a closer look here at the phenomenal year for crypto, potentially another phenomenal year up ahead, and headlines crossing the wire right now. MicroStrategy and Michael Saylor, Emily, buying more Bitcoin as he does, 8th consecutive week that he's been buying $209 million worth. When we come back, a focus on the oil and gas space with Patrick Haan over at GasBuddy. Stick with us. This is Bloomberg Surveillance. Welcome back to Bloomberg Surveillance. Equity futures here in the U.S. on the back foot once again. And Emily, we talk about this idea of kind of what investors are preparing for. Of course, we don't expect a whole lot of price action this week. It's a holiday shortened week. A lot of people still aren't back from vacation. But once we come back next week, things are going to change. People are going to hit the ground, particularly with the new administration in Washington, and maybe new hopes for an extension of this rally?
Yeah, I mean, that's certainly what the Santa Claus rally promises. It extends into January, and then it means that there are positive gains up ahead.
Does Santa Claus know we named a rally after him?
Because Santa Claus knows everything, Romaine. He knows if you're sleeping.
And he knows if you're awake. Good for you, Emily. Let's take a look at what's been going on in the energy space here. Because while it has been a phenomenal year for equities, not really a good year in energy markets. Oil futures, both here and in London, now in the red on a year-to-date basis. They're holding on to modest gains on the day. And that's raising a lot of questions about what could be an unpredictable year in 2025 with a lot of unknowns surrounding incoming President Donald Trump's energy policies. Patrick DeHaan over at GasBuddy writing, quote, look for oil in the 60s and 70s this year, which is pretty much where they are now. There is a chance, he says, that it could even fall into the upper 50s. Changing dynamics for geopolitical tensions, also potentially posing a risk. Patrick joins us right now to talk a little bit more about his outlook for energy prices. And it's kind of a big contrast to what we saw at the start of 2024 when we had that 10, 15% rally and everybody was talking about oil at $100 and beyond. And we've come a long way since then, just not in the right direction. Well, not in the right direction if you're an oil producer.
Yeah, that's right. I think the bulls have been chased away, at least for now. And under the President Trump's mantra of drill, baby, drill, I think it may be another challenging year, at least for oil. Keep in mind OPEC's production cuts, keeping about 5 million barrels a day of spare capacity offline. That's where some of the downside risk potentially comes. Now, I don't necessarily believe that OPEC's going to open the spigot back up in April. That's what they've delayed their restoration to for now. But I think it's going to be another challenging year for the upstream, whereas you still are going to see your seasonal swings when it comes to the midstream, the refiners. Maybe good news, though, for pipeline operators who may be able to expand a little bit more readily available. And then the retail sector. I think the C-store level is going to experience another good year. But for oil, there aren't a whole lot of upside risks now. I think there's more downside potential than upside for 2025.
Just staying on oil for 1 second, particularly on the production side, because I know there was a lot of optimism about the Trump administration coming in, particularly given the policies we saw the first time around. But there is an issue of capacity right now, and whether there is anything to drill, baby, drill into that we haven't already drilled, baby, drilled already into.
Yeah, I mean, exactly right. The Permian has been maturing. Now there's been talk about potentially reopening the Arctic wildlife refuge. So, that's something there as well. But I don't look for oil companies to go into rural Alaska and to be really excited about potentially drilling there. I think there's a lot of challenges with that. And keep in mind, getting that oil online could take potentially years, if not longer than that. So the Permian is slowing down. So there potentially is some upside there. But keep in mind, OPEC's spare capacity, Guyana as well, seeing a huge increase in capacity. I think one of the wild cards in terms of risk, keep in mind, is that Canada sends us over 4 million barrels of Canadian heavy oil every day through a couple of different pipelines. And of course, President-elect Trump's promise on tariffs. Well, I think that I'd like to fall that under as talk, but you never really know. And again, President Trump's kind of against the status quo, at least on some of these issues that do pose a potential upside risk for oil in the year ahead.
I want to go to your outlook for 2025. But first, can you just reflect back on the year that was in oil? WTI basically flat for 2024. What was really driving that, lack of movement?
Well, on the supply side, OPEC had been taking barrels out of the market. There wasn't a whole lot to get excited on the demand side of things. China's economy has been incredibly weak. Not only that, but they've been pushing EVs much harder. And keep in mind that their gasoline demand may have already peaked now moving forward. And so Chinese demand is a huge headwind for this market. And it comes as there's a lot of supply that remains offline, and the U.S. is back at producing record amounts of crude oil ourselves at about 13.6 million barrels a day. So I think a lot of this story is really focused on the China economy that really has struggled for much of this year. Now there's a promise of stimulus moving forward, but there's simply too many spare barrels sitting offline here for the market to really see much of a run up. Now, I think we could see a bit of a spring surge. That may be tied more to refined products, but we'll have to keep an eye on the U.S. economy. I mean, there's a lot of potential possibilities that could slow our economy down, which in turn could also slow down global oil consumption.
How do you think about inflation for 2025? Because at least at the Federal Reserve, the FOMC members did up their inflation projections. How do you kind of take inflation into your forecast?
Well, as you indicate, I mean, a year ago, we were sitting here talking about waiting for the Fed to cut interest rates rather aggressively. And now they've really toned that down. And now there's more caution in their statements. And that could pose a negative for oil as well. I don't think oil or energy is going to be inflationary in 2025, but it's obviously a risk factor. If the Fed slows down its interest rate cuts, there could be ramifications for the dollar. And of course, the dollar right now has been fairly strong. So keep in mind that oil is globally traded in dollars. That could even have an impact on the price of oil, and certainly something we'll be watching in the year ahead.
I am curious, Patrick, and maybe if we can circle this back to the consumer. There was obviously a lot of talk during this election cycle about gas prices, despite the fact that, at least as of today, gas prices at the pump are about 40% lower than where they were, I think, about a year ago or so. It gets to the question here as to whether we see prices at the pump, at the retail level, kind of remain where they are, maybe even go lower, or are there some forces out there where maybe we should prepare ourselves for higher prices ahead?
Well, I think for consumers, it's going to be a third year straight of declines. Ever since 2022, the yearly national average, again in 2025, likely to trend lower. Now, consumers shouldn't mistake that for flat gas prices through the year, because we will see gas prices start to go up as we get closer to warmer weather. By the way, according to GasBuddy data this morning, one of those rare moments where the national average has slipped below the $3 a gallon mark. I do think that will be temporary. And in the spring, we will see that surge. Prices will probably run up 25 to 50 cents a gallon, and they could get closer to the mid and upper $3 mark. But that's going to stop short of what we saw last year when the national average peaked at about $3.67 a gallon. So it's good news for consumers. They probably won't be shelling out as much in 2025. But keep in mind, President Trump's promise to cut energy prices in half, that's a big difference. Talking about prices at $3 versus his promise of cutting them in half, which would represent a price below $2.
Yeah, something we haven't really seen on a sustained basis, probably since I was in diapers. Patrick, I am curious about this idea of an export economy for our energy. We've obviously seen the U.S. over the last few years become energy independent, and of course now has a relatively thriving export business. How much can that expand based on our own demands here locally, and how much is going to be left over to ship out and sell to other folks overseas?
Well, I mean, you're looking at U.S. exports. A lot of that is lighter, sweeter crude oil. And really the bigger boom is LNG. And that's what certainly could expand under President Trump. The exports of LNG, I mean, he's already threatening Europe that if they don't buy additional U.S. energy, that there's going to be ramifications. And I do think there's room to grow. Well, natural gas prices have been blossoming here in the last couple of months on the promise of potentially more exports. Natural gas now above the $3 mark. So I think there is room to grow. The U.S. is the world's largest energy producer, and I think we'll probably see that continue to grow in the years ahead, especially as Russia continues its war in Ukraine and Europe continues to turn to the U.S. So I think there's a lot of promise in U.S. exports. And again, look for exports, especially of LNG and crude oil, to continue increasing this year as countries potentially make the shift and as President Trump may push countries to make the switch over to U.S. energy.
Patrick, what geopolitical risks are you looking at for 2025 that could potentially pose a risk to your forecasts?
Well, again, I think President Trump is a bit of a wild card. What he says and what he does, it's a little bit against the status quo to come out and, talk about potentially putting tariffs on oil and other things, everything really from Canada and Mexico. So the political relationships could shift in the years ahead. And keep in mind, China, still a really big one. How they're shifting away from fossil fuels is a big turning point here. They've potentially already seen peak consumption. We turn to India to see growth there as well. So, and there's a lot of geopolitical issues. The Middle East has been quieting down, but there's still the potential of conflict there, and Russia's invasion of Ukraine, certainly something to keep an eye on. But I think geopolitically, with somebody like President Trump in the White House, he may strong arm other countries into potentially doing what he likes a little bit more. And that certainly could keep energy prices from climbing much more substantially if he uses that strong arm frequently.
I'm curious, do you think there will be any sort of meaningful global coordination on some of this? Obviously, we know OPEC Plus has its own cartel, but in the past we have seen cooperation, for lack of a better word, among some of the other major oil producers that aren't in OPEC in dealing with OPEC? Or is just the relationship so fractured and so disparate right now that investors shouldn't pay any attention to that?
Well, I think it is certainly fractured. I think there's dissension amongst the ranks at OPEC. I mean, we've already seen some of that. Some countries certainly want to raise production. Saudi Arabia and Russia kind of going against that, trying to hold the line. The Saudis are spending a lot of money, and they have a lot at stake here if oil prices were to decline even more significantly. So there's certainly some driving factors. But again, some OPEC members do want to increase production while others do not. And that's something to keep an eye on. OPEC is certainly not as coordinated as it once was.
All right, Patrick, great stuff. Patrick Haan over at GasBuddy, a closer look here at the oil and gas market. And we kind of put this in the context, Emily, of this, of course, being the holiday travel season. I was looking at some statistics because I didn't quite realize this, but basically the projection is about 120 million people traveled more than 50 miles from their home over this holiday period. Almost all of those, more than 100 million of those, were by car, not by airplane, which I guess makes sense, guys, there's a lot of people. I mean, we talk about this idea of whether that sort of continues into the season next year or into the summer season next year, et cetera, et cetera. Is there going to be enough appetite for that, particularly with gas prices being as low as they are?
Yeah, and also considering that flying is not always the most fun activity. Yeah. There's delays, there's difficulty on the airplane boarding, and it's getting more expensive.
And it's getting louder. Have you noticed this trend of people who apparently don't own headphones for some reason or another? So they pull out their phone or their tablet and they just play whatever, movie or video they want. I'm like, what are you doing, dude?
I feel like as a New York City resident, that wouldn't bother me because on the subway, everyone is already playing their speaker and music. But I could see to a non-city dweller how that would be very alarming.
Yeah, well, as a New York City dweller, I just keep my noise-canceling headphones in so I can ignore everyone on the New York City subway and hopefully survive. All right, let's get you an update on some of the other stories out there this morning. Your Bloomberg Brief right here on Bloomberg Surveillance, and a focus on Ukraine's largest mobile operator and a partnership with Elon Musk's Starlink to introduce satellite-powered cellular service in the country. The deal allows the company's customers to use space-based connectivity when terrestrial networks are unavailable, with text messaging expected somewhere towards the end of 2025. Now, this partnership aims to provide telecom infrastructure resistant to Russian attacks, which have regularly targeted Ukrainian infrastructure since the invasion back in 2022. Meanwhile, a big supplier for NVIDIA, Ibiden, is weighing faster expansion to meet demand for chip package substrates used in NVIDIA semiconductors. The company building a new substrate factory in Japan, but may need to actually accelerate capacity increases to keep up with customer demand. The CEO of that company saying sales of AI-use substrates are robust and demand is likely to last through next year. And Charles Dolan, how about this? He's a paid television pioneer. He founded HBO. He built Cablevision into the 5th largest U.S. cable company. He's passed away. He passed away yesterday at the age of 98. He was regarded as a maverick, a visionary, really, in the world of television, who continually surprised investors and rivals while vexing a lot of folks on Wall Street by periodically running up his company's debt. That might be an understatement, but it paid off in a big way. In 1997, Dolan became the owner of Madison Square Garden and its two main tenants, you may have heard of them, the New York Knicks and the New York Rangers. That is your Bloomberg Business Brief. And Emily, I know you're from the Northeast area. I don't know if you're a Knicks fan or a Rangers fan, but we talk about Charles Dolan and what he built. I mean, HBO was phenomenal. And it's hard to kind of overstate just how impactful HBO at the time when it came out. I mean, there was nothing like that to get movies on demand in that way. Programming, they were doing sports programming back then, too. A lot of people forgot. And to get that in a way that just didn't exist, even on network television back then, absolutely remarkable.
Right. And now I feel like we take it for granted, consumers do, that you can just turn on your TV and you can basically get any program with HBO Max. That is one of those names that's still carrying on today.
And of course, his legacy lives on with his son, who's now, of course, in charge of MSG. I don't know if you're a big sports fan or not, but
I am going to my first Knicks game in January.
Well, there you go. Should be fun. Of course, the Knicks, they're a decent team. They had a good run last year. We'll see if they can repeat this year. Anyway, Charles Dolan passing away at the age of 98, a pioneer, really. Not so much in the world of sports, but in the world of television, of course, with the shepherding of Cablevision and his co-founding of HBO. We're going to take a look at the life and legacy of someone else who passed away, and that is Jimmy Carter, 100 years of age, passing away overnight here. We're going to talk about exactly what he meant to this country and the legacy he leaves behind. That's coming up next, right here on Bloomberg Surveillance. Welcome back to Bloomberg Surveillance. A quick check on the markets here. S&P futures remain on the back foot, setting up for what could potentially be a third straight day of declines for the major index. Unchanged right now on euro dollar, and your 10-year yield continues to drift lower here now at 4.56 and change, down 6 basis points here. A focus on the financial markets and a focus on politics and a focus on the life and legacy of Jimmy Carter. That's under surveillance this morning.
President Carter came to office in the wake of Watergate and Vietnam with a commitment to right the ship of state.
President Carter brought back to government honesty, integrity, and faith in government. He ran as a candidate on a government as good as its people, and he truly did deliver that.
I think President Carter in many ways was ahead of his time in terms of his emphasis, for example, on human rights, in terms of his thinking about alternative energy, in terms of his role in the Middle East peace agreements that he put together. And we all know that his ex-presidency, which has been such a long one, has been graced by remarkable contributions to humanity by former President Carter. I think right now, he is seen very favorably. I'm really happy to see that because he's a very special man.
One of President Carter's biggest challenges was energy in the face of the second Arab oil embargo.
Well, he was president during a very challenging time. As you recall, there was the oil embargo, which drove oil prices up dramatically. That became a catalyst for the highest inflation that we had really since the war, and probably even before that. And so he had to take some very tough fiscal measures. He did appoint Paul Volcker, who, by very much tightening monetary policy, caused a recession, which certainly was not an easy thing for President Carter to run through.
He was the first person to talk about energy and how we had to start looking at renewable energy plans and how our country could invest and incentivize in that area. And I don't know if you remember, but he had a solar panel on the White House, which when he left, President Reagan took down. But he had fuel mileage standards and, really realized, I think, way before anybody else that we had to start thinking about what climate and what it was doing to our planet.
But as influential as Jimmy Carter was as president, he will be remembered every bit as much for what he did after he left office.
The thing, though, that I think is absolutely most notable about President Carter is we can all debate the relative merits of any individual president's term, but I think it's inarguable that President Carter is the single most impressive, most successful, and most to be admired ex-president in the history of our nation. This is a man who took the responsibilities of being a visible public figure incredibly seriously and was a role model to all of us.
And January 9th here in the U.S. will be a national day of mourning for former President Jimmy Carter. That announcement being made by current President Joe Biden. And typically on those national days of mourning, markets will be closed. We'll continue to monitor that situation as we count down, of course, to the official remembrances for the 39th President of the United States. But when we talk about that legacy, we have to kind of talk about what actually got him into office in the first place. William Doyle joins us right now. He's the author of Inside the Oval Office and Titan of the Senate. And I do want to go back to 1976, if you will, maybe even before that. There was no way anyone thought that Jimmy Carter was going to win the presidency. He shocked a lot of people in those Iowa caucuses, ends up defeating Ford. And I am curious about what laid the foundation for him to go from a relatively unknown governor in a southern state to being president of the United States.
Well, I think you identified one of the keys, which is South. Jimmy Carter was the last Democratic candidate to sweep the so-called solid South. And he had an unusual appeal to black voters, to centrist and conservative white voters, and to people who were really ready for a change. And of course, we had a assassinated president in Kennedy. We had a presidency kind of in ruins after Lyndon Johnson's failed at the end of his presidency, and of course Richard Nixon and Jerry Ford's very short presidency. Americans were ready for something entirely new, and Carter, in a sense, was the perfect president for that time, although he was perhaps doomed from the start because he was not a very good communicator, and he hated politics, ironically. Everyone will tell you that. And so he was much more concerned about the technical details of issues and fixing them than he was about being a Republican or a Democrat. He was a technocrat.
Well, I'm glad you brought that up, too, because it kind of leads us to 1980 and him losing the election to Reagan, who in a lot of ways was almost the exact opposite. Not necessarily the best administrator, but obviously just a magnificent politician who knew exactly how to communicate with the people. Why didn't Carter end up with a second term? Was it because of the lack of communication, the lack of connection?
Well, I think that was a huge problem, especially in relation to Reagan, who was an absolute master on a level of Franklin Roosevelt or John Kennedy in terms of connecting to the American heartbeat and communicating. But of course, Carter was in terrible political trouble with the after effects of multiple energy shocks. Inflation went through the roof, unemployment went through the roof to staggering numbers, and then came the Iran hostage crisis, which sort of sealed his fate. But I think we have to remember that Jimmy Carter laid the foundation for the Reagan Revolution. He initiated strong action against the Soviets. He started the defense buildup that Reagan accelerated soon after. In fact, Jimmy Carter was a retroactive hero of the Gulf War of 1990 and 1991, because back in the 70s, he was championing high-tech, long-range weapons like the Tomahawk missile, cruise missiles, and the stealth bomber, all of which were used to very effective use by the first President Bush in winning the Gulf War. So Carter was always very concerned about long-range results rather than short term.
Yeah, and that, of course, was one of the big compliments for him, and also, to a certain extent, one of the big criticisms. We have to leave it there. William Doyle, the author of Inside the Oval Office and Titan of the Senate, a closer look at the 39th President of the United States, Jimmy Carter, passing away at the age of 100. We should point out, Emily, he was the longest had the longest life of post-presidency of any president in history, almost 40 years.
Yeah, and 100 years of life, which is just incredible, Romaine.
All right, coming up here tomorrow on Bloomberg Surveillance, a conversation with John Stolfitz, Brooke May, and Sebastian Page. This is Bloomberg Surveillance.